Morning, everybody. This is Grace Barnard from NIW. We're going to get started here in just a minute. I just need to make sure all the equipment's working. Charles Hale, are you there? Charles, are you there? All right, that's not working. So, Bob, I guess you're there.
Good morning. Good morning. Everything is clear.
Fantastic. Thank you so much, Bob. Appreciate your help. All right, it looks like we got everything up and going, so we'll just give all the participants about 5 minutes before 11 o'clock. So we'll give everybody else about 5 minutes to log in. So in the meantime, I put the dates, the next tranche deadline dates up on the website for everybody so that you know that there's only one more deadline before now and the end of the year. So the next enrollment coming up between now and the end of the year, the deadline for paperwork, underwriting, everything is October 26th, which means that we will fund on December 7th. Just so you guys know, these groups are getting bigger and bigger and bigger, which it's requiring us to take a little bit longer once we give you the paperwork deadline. So please don't wait until October 26th to send in that paperwork. We really need that paperwork before October the 26th. That way it doesn't take us so long to get these tranches done and funded. What really takes us the length of time is everybody waits until, October 26th to send their paperwork in, and then you've got 500 different accounts you're trying to go through and send to the bank for due diligence so that they can add up how much money they have so that they can take it to credit and determine the loan size. So the quicker you get the paperwork in, the better. I always say to the clients, don't wait, because you don't want to miss the deadline for some last minute thing that you might not anticipate, like for whatever reason your banks didn't transfer the funds correctly, or Federal Express didn't show up, or whatever the unforeseen instances are. I always tell people, get it done now. It's out of your account. You've got it off your mind, and then start looking for the coverage in December. That seems to be appropriate for my clients. So we still have about 3 more minutes, and we've got a lot of people trying to get on today. So I really need to wait right up until 11 o'clock just to make sure everybody gets on. Some of the stuff we're going to be covering today is going to be how you sell to an individual, how you sell to groups. I kind of want to go through commissions as well if we have time, question and answers, and then give you guys opportunity to raise your hand if you have stuff that's working for you, or if you have any comments or suggestions that might make it easier for everybody who's participating on the call today. Obviously the point of this enrollment is to help you make as much money as possible, and that's the process that we're in. That's the process we want to try to cover today. So again, let's just give it a couple more minutes. While we're sitting here waiting on everybody to jump online, is there anybody that's online already that might have a question or comment? We might as well kill the time with anybody up front that might want to give some input or something they'd like to see or hear that hasn't been covered before. Anybody? Okay, well, I guess we're just killing time then. One of the things, oh, there you go. Hey, On, how are you? I can't unmute you, On. You need to enter your 2-digit PIN number. Ben, you had a question?
Can you hear me? I asked it.
Oh, sorry, I couldn't hear you. I can hear you now.
I actually wrote it out.
Oh, I see it. I got it. Okay. You know, the problem for me when guys write questions is I have to go pull up a different screen. So, but yeah, I'm going to go through, I think I'm going to go through commissions today. And while we're sitting here, I see some other people have written questions out. So let me address some of those. On the allocations, obviously the clients have the choice to pick some of the allocations, but just keep in mind that if they pick the allocations themselves, then you know, you need to make sure that the client, we want the clients to sign off on that, and you want to make sure that the clients know that the way we've designed this is based around the optimized allocations that we have actually illustrated and stress tested. So for instance, if they go and put half the money in the fixed account and the other half of the money in some type of index, that doesn't mean they're going to have enough cash in this plan to foresee it for the 15 years without them having to participate and put more in there. The way we've designed it is around the option choices, the index choices that we're making, and we've stress tested around those indexes. So if they do anything outside of that, then you need to make them aware that it could create a margin call or a collateral call for them where they may end up having to put more money into the policy to secure it in the event of a Great Depression or a high interest rate of the 80s. So we can talk about that more later at the end, but make sure that if you tell them they deviate from our cookie cutter, that they're doing that deviation at their own risk. And, you know, if you get out to the 7th year and you have to dump more money in, that's not the way we've designed the plan, and that's why we want them to sign off on that. Charles Hale, you said you have your first big group and you want help, so let's take that offline and have a conversation about that after this webinar, if you don't mind. Let's spend 5 minutes or so after the webinar's over, and we'll kind of walk through with your cases. Somebody wrote in here, this is new to me, does the bank need collateral? No, the bank does not need collateral. The contributions into the plan up front is what the bank is going to be securing against. Okay, so guys, we're now at 11 o'clock, so I'm going to get off the questions page and we'll come back to that at the end. Okay, so you guys will have the opportunity to go through question and answers again. What we want to try to cover today, by the way, my name is Grace Barnard. I'm the president of NIW. And what we're going to try to cover today is, first off, guys, you don't want to sell this if you don't know how you're going to make money. So let's go through the commissions and the different markets, right? So if you're selling to an individual, how do you make money in this if it's spread comp and all the other things associated with it? If you're in the group market, how do you make money off of this? And so, and the problem with doing commissions is I can't be specific because I'm not your GA. I don't know what commission level you're on. You know, I have no idea how your system is set up. All I can tell you is, you know, I can give you a guide, and then what you'll need to do is you'll kind of need to call and talk this through with your GA, okay? And I'm just going to kind of give you a guide on the LSW product because I happen to have that spreadsheet with me today. But listen, guys, it works very similar with Minnesota Life and Emeritus and Allianz. So you don't need to be spreadsheeting this and trying to go around and compare, you know, one insurance company versus another. They're all very, very similar, okay? So first and foremost, let's talk about the carriers. Wait, let me go back to that for just a second. Whoever the carrier is that you're using, the first thing that you want to do is you want to be able to go online and log in. And this is where all your data is going to be housed as an agent so that you can access marketing materials and PowerPoints and, you know, illustrations and all that kind of stuff. And so you just go in here and you pick the carrier of choice, whichever carrier that is, and then you can gather all the data from there. And we'll go through that in a minute as well. But that's the first thing, right? So now we want to talk about commissions. If you are selling this to individuals, then, oh wait, sorry. Okay. If you guys are selling to individuals, the first thing that you want to do is you want to say, what is the market? How do I make money at this? Now, from my standpoint, the way I started out, this was not our market. This wasn't even the business that we were doing. We were only dealing with high net worth clients. And if you think about this from a high net worth perspective, you're selling much, much larger targets, much, much higher premiums. And so it's cost effective for you to chase around a $20 million client, you know, and spend a year trying to close that case, right? So if you think about the way that the Kai-Zen was set up, the Kai-Zen was set up as a group benefit plan, right? So your goal was for you to go out and sign up a group. Now, signing up a group is the same as going after a high net worth client and trying to sell a $20 million face amount, because you're selling lots of clients, but you're still doing the $20 million collective face amount. And so they're all big dollars and they're all big commissions. So when we made the switch and allowed you to also include individuals, we did that very specifically. Let me tell you why we did that specifically. The focus is for you to still get large numbers, whether you get those large numbers with one individual group or whether you collectively sign up one a month. The point is that these are smaller commissions and spread comp to make the design work. And the whole purpose of this was to give you the ability to go out and sign up larger numbers. Now, what happened to me was I would go out to CPAs, I would go out to attorneys, and I would take this plan to them and I would say to them, hey, look at this plan. What do you think about it? And do you have clients that would be interested in this? And what was happening to me was those CPAs and attorneys were saying, I love this plan and I want to do this my plan myself. Can I participate? And originally we said no, because it was designed for groups and we needed large numbers to be able to get the pricing on the loan and to be able to do all the things that we wanted to do to make it cost effective and even make any money out of it. But later I started thinking, wow, you know, I've been out prospecting to 5 or 6 or 7 CPA firms in a day, and every single appointment I've gone on, somebody has told me they want to participate. And does it really matter if I get a 20-man group versus getting one a day or one a month or whatever those numbers are? And so I started thinking, this doesn't make sense for me to not sell these people. And so from that point on, I kind of came back to the company and I said, hey, what if we, instead of just having a group, enrolling that big group and then only allowing them to participate, what if we set up our own groups and let everybody that wants one client across the United States to be able to sign up that one individual person and put them in what we call the tranches, and that's the stuff you guys see on the website. Those are the dates on the website. And then we can collectively get these big groups, and the agents don't have to worry about trying to pull together 20 or 30 people to get that group. And so we started doing that, and that became very, very popular, but you still have to make money at it. So what I started to tell people is, look, here's a breakdown, and this is the LSW product, but the average premium, first and foremost, what you need to do is you need to go out and you need to sell to the client, right? How much can you contribute? Now, when you're selling them an index product today, that's the same thing that you're doing. You're going out and you're saying, tell me how much money that you can afford to put in this plan. And let's assume that they tell you that the annual premium is $25,000, right? And that's all they have, and that's all they can afford to put into the plan. And so this would be kind of the normal compensation that you would be able to get if you were doing a spread comp on one case. And this is the amount that you would be able to get, this $2,625. You would get that years 1 through 6. And then from that point, the 10-year compensation to you would be about $4,375,000, and that is for the $25,000 premium that you guys are typically selling. But once you get the client to say, hey, I'm putting in $25,000, that's not actually what they're really doing here. Now we're going to add the leveraging piece. So we're going to add an extra $25,000 to that client. If the client says he can afford 50, then we're going to make that number 100. I did the wrong number, sorry, I did 500. Okay, so now for a $50,000 case, typically that's about 12,500 of target, and I'm just using averages, guys, so these are not specific numbers. But the point I'm trying to say here is, look, guys, you are making more money by participating even within IW's 70% split on Kai-Zen. So you still make years 1 through 6 about $2,300 a year, but over the 10-year period of time, you've made about $17,400. So you've made $13,000 over 6 years, you've made $17,000 over 10 years. So it's not the commission split that you're doing within IW that makes you think that you're getting less money. You're actually making more money, because what you sold the client yourself was, I can afford to give you $25,000 a year. That's all I can afford to give you. So if you go out and you sell that on your own and you get 100% of the comp, you made a lot less money, right? But if you're doing it here, we're adding that additional $50,000, $25,000 to it. We're minimizing fees and expenses and charges in this design so that we don't have to get loan documents and we don't have to go through financial underwriting and all that other stuff to make it appealing. Now, what I say to agents is, look, you're not going to make that much money off of this if you're only selling one at a time. You've got to go out and you've got to sell one a month. Now, if you go out and you sell one a month, you're going to make a lot more money, and something's wrong with this formula. But basically, if you sell 10 a year, and I need to go get them to fix this formula because I'm not sure what's wrong with it. But if you sell 10 of these a year, you'll make over $1 million. And that's only for the next 5 years, and that's only 50. Now, sorry guys, I don't know what's wrong with this formula. It's not filling it in down here at the bottom to tell you what you're actually, oh, sorry, it is. I forgot, this is annual. Okay, so like, let's say the first year you only make $27,000, but the next year you're gonna make 55, and then 83, and 111, and so on, and so on, and so on, and so on. So you can kind of go in here and say, look, if I'm only selling one a month, you can figure out how many you need to sell a year to make it cost effective. If this is in addition to whatever else you're selling, then you add it on. If your point of trying to do this is to sign up people while you're prospecting, again, the ultimate goal is to get a group. Now, let me show you what happened with a group that I'm doing. So I got a 4,000 man company, and they said that they're going to be contributing about $50,000 a piece per doctor. And they said that they don't know how many people will want to sign up for the plan. So I just did some very, very low numbers, just rough low numbers, right? And by the way, guys, it took me 2.5 years to get this group. So just so you know, just like any large case, they're time consuming. So in the meantime, you want to sign up every individual so that you can get people to introduce you to these large groups so that you can get in front of them so you can land one of them, right? So this was my first one that I landed, 4,000 people. I said, what if I don't get the normal voluntary enrollment and I only signed up 10% of those 400? And what if those people only put in $25,000 a year instead of $50,000 a year? Okay, well, we're going to be leveraging it up. So if you take that 400 people and you put in that $50,000 here, and let's just say that that target is 12,500 again, and doesn't matter what the numbers are. And I take that 2318 in year one times 400. I've made $927,000 in year one off of that enrollment. So in over a 10-year period of time, I would make 17,000. So you take that 17,412 times 400, And I've made $6,964,000 for signing up that one group that took me 2.5 years to sign up. Now, I have a better spreadsheet than this one that really walks through all of the carriers and it breaks each one out. And we can go over those. And I don't know what your commission level is, and so you can, build in the commission levels. But the point I'm trying to make is, look, guys, the point of this is it's a spread comp. And what I try to go for is I try to gear my number so that I'm averaging about $5,000 per person that I'm signing up. So I want to be able to get 5,000 per person, and I want to sell at least one a month. That's me. That's my personal goal. That was my goal when I started out. So I started out signing up one person a month, and then same thing the next year. And my goal was to do that for 5 years. And I stuck to my goal, and I was hitting those goals. And on top of that, then I landed the 4,000 man company. Now, if I get anything better than that 10% of those 4,000 doctors, and if I get anything better than them putting in $25,000 a piece, that's just more money. So kind of tried to set in my head my goals. It's something that's attainable. And the whole purpose of signing up the one a month was so that one of those people would say, you know what, I've got a company. And what ended up happening is over the 5 years that I've been doing that, I have had people re-up. So over 50% of the people that got into this plan did another one. I've had people come back and tell me they want to put their spouses. I've had people come back and sign up small businesses, so 10-man groups and 15-man groups and all these small businesses. And so all of those individual sales that I have done over the 5 years have led into much, much more business that I didn't have to go out and generate on my own, and it landed me that one large case. If that is not your focus and you're not interested in doing that, you should not be selling Kai-Zen unless you're selling it as an add-on to your existing business. So let me give you another quick point. There's a gentleman that I introduced at the NIW University. His name is Simon Chu. Simon Chu is in the health insurance business. He sells health insurance benefits, and that's what he does for a living. He made one change to his business. He didn't stop selling his health insurance benefits. He didn't do anything except he made one addition. He went in, and when he went to talk to the company owners that he was selling the health insurance to, he said, and I have a plan for you. This plan is for the business owners and the highly compensated partners of your firm. And this is a plan for you to help you supplement your retirement. He sold 11 in the first year. He sold 13 in the second year. The premium, the target premium on those 24? On those 24 people was $620,000 of additional target. Now that's a spread comp. So if you just take that 620, it's not exact because you actually make more than the 620. But if you took that 620 target and divided whatever that commission was out by 10 years, you can see that was a very significant increase in what he was already doing. And that makes a lot of sense for him to do that. Now, in his third year, he's already signed up more than 24 people. So in a 4-year period of time, he's done about close to $1.5 million of target premium. And that's just he didn't change anything that he was already doing. He just added it to his existing book of business. So if you're going to sell this individually, you want to add it to your existing book of business. This can be an incredible additional income source for you. If you run into a group, this can be a windfall. So if that's not your intention, you probably shouldn't be doing Kai-Zen. Okay, so I hope that was helpful, and we can talk more about that at the end, but I want to try to get to the PowerPoint, and I want to try to get into what it is that I've been doing when I go out to talk to people. Now, keep in mind, I said that the purpose of this plan is for us to try to go after the groups. And so when you're out talking to people, there's a couple of key things that you need to use as elevators presentations, right? So people always ask me, how do you get the appointment? Okay, if I'm talking to a business owner, I just in simple conversation ask them what is their goal for their company going forward? What is their personal goal? In other words, are they trying to, run this business and build it up so that they can sell it down the road and make it successful? I mean, 9 out of the 10 people that you're going to talk to are going to say, yes, that's the goal. Okay. So what is it from an employee standpoint that's keeping you from reaching those goals, right? Do you have to keep your key people? Is keeping your key people critical to the success of your company? And they always say yes. Okay. If that's a critical part of your business plan to be able to have these key people there so that you can ultimately sell the business, because the business is worth nothing if you don't have this staff of people, this business there with the key people to continue to run it so that you can go off into retirement, right? That's the whole purpose of this. So those key people are very, very important to business owners, and you need to focus on that, and you need to ask them, if I could show you a way to provide an amazing retention plan, something that isn't just slightly different than what everybody else is doing. This is significantly different than what everybody else is doing. You could actually double what you're providing them from a benefit standpoint, and you can double what you're providing for their retirement for your employees without having to use additional money than what you're already spending today, if you're providing benefits. So if you're already providing bonuses, if you're already providing deferred comps, if you're already providing something to those people, and you want to make that double what they're getting right now without spending additional money, would you give me 20 minutes of your time? Okay, so that's what works for me. I'm not saying that that's the elevator presentation that you guys need to use. That's just been working for me really, really well. And I'll show you a different one for individuals. So the first thing when you're out talking to a company and they give you that 20 minutes, then you're going to go in and you're going to use a PowerPoint that looks something like this. Okay. First off, you're the business owner. You are working really, really hard for the success of your business, and you haven't had time to protect your business, not only your business, but yourself personally, right? You've spent so much time and energy and effort putting all this money into your business, and what for, right? Well, obviously the dream is for you to ultimately be able to sell this company and go away and retire, right? But what's keeping you from being able to do that right now, today? Right now, what is stopping you from just selling this company, getting on a boat, or going and buying that dream house on the beach and retiring and just walking away from it all? The number one thing that you're going to hear is they don't have enough money yet. They haven't saved enough. They won't be able to sell their business for enough. They don't have a buyer. It's always surrounded around money. And that's the perfect answer, because the money is always the problem. It doesn't matter if you're an individual. It doesn't matter if you're a business owner. It's always about money. Benefits are always about money. I don't have enough money to provide more benefits than what I'm currently doing today. I don't have enough money to retire and live in the lifestyle that I am accustomed to living in today. So what is it that Kai-Zen is offering? We're offering more money. So guys, don't get hung up on the product. Don't get hung up on selling index policies. You're already doing that today. That's not what your problem is. Your problem is they don't have or don't want to spend the money, right? So what we're doing that's different than everybody else is we're providing them the one thing that nobody else is offering them, and that's the additional money. Kai-Zen provides more money today so that they can take out more money in retirement. It's going to provide more protections for themselves and their families and their employees' families, and it's going to provide more confidence than any other plan that they have in place today. So let's talk about the corporate market. First off, Highly skilled employees are vital to the success of your business, Mr. Employer. And we know that because 87% of employers said improving retention is a critical priority for their company. Why? Because we have a skill shortfall. We have the largest number of baby boomers retiring that we've ever had, and we're going to have a 16 million shortfall in skilled workers. So what does that mean? Headhunters will tell you if you're looking for employees, go steal them from your competitors. If that's the case, and you're going to steal employees from somebody else, how long do you think your employees are going to stick around if they know pensions are virtually extinct? Everybody's offloading pensions. Everybody's trying to get rid of deferred comp plans. Everybody's trying to get rid of those long-term contingent liabilities on their firm. Job security is close to nil. So how long would your employees stick around if they knew there was a competitor down the street that was offering them 60% more money in retirement and 50% better benefits for themselves and their families? We know employers are right now currently spending 40 to 80% of their gross revenues on employee salaries and employee benefits like health insurance and 401ks. So I'm not even talking about deferred comp, bonuses, and all the other things that businesses are paying. We also know that employers are getting away from those long-term liabilities because if you hire somebody at 45, you've got to make that commitment as a firm from 45 to 65. Businesses don't have the ability to plan 20-year long-term goals. They try to do them in short-term spurts. What's our 10-year goal? What's our 5-year goal? So it's very difficult for a company to know if they're going to have the revenue to maintain these commitments every single year for the next 20 years. That's why people are trying to get rid of these longer term commitments. However, those same employers also know that if they don't do something to keep these people from a retention standpoint, that if they lose them to a competitor, it's going to cost them 400% of that base person's salary just to rehire and replace them. And we have the solution. We have the solution to help those employers not only attract but retain those skilled employees. And it isn't just like everybody else's plan. This is significantly different. So the first thing that we want you as an employer to be able to say to your employees is, employees, we've listened to you, we know what your financial concerns are, and we are providing you the benefits that you want and you need. First, we are going to provide for you if you become ill between now and the time that you pass away. We are going to provide for you, your family, in the event that you happen to pass away at any time, and we're going to provide more income for you, and I meant to say more, and we're going to provide more income for you in retirement than what you're currently able to do on your own. Now, let me show you how similar this is to your 401k. I'm not suggesting that we tell anybody to participate in the Kai-Zen plan versus the 401k, because the people that we're going after are already maxing out their 401ks, and that's not going to be enough for them. And those are the people that are looking to supplement over and above that. The reason I'm using the 401k analogy is because everybody knows what a 401k is. And so I want to show you how similar what we're doing is. So the Kai-Zen plan would take the place of a bonus or a deferred comp or some other type of incentive over and above the 401k. But in a 401k, you have the ability to buy stocks and bonds. When you buy those stocks, you have the ability to get 100% of the upside of the market, but you also get to take 100% of the risk. But in our plan, we're going to cap the upside on about 80%, but we're going to take away all the market risk. So here, you're going to get 80% growth, but none of the market risk. In a 401k, you get to grow that money tax deferred, but you have to pay taxes on the distributions. Here, you get to grow the money tax deferred, and you can access that money tax free as well. On the 401k, you're limited in the contribution amounts that you can put into the plan, Here, you're not limited. Also, with the 401k, your employer typically gives you some kind of match, maybe up to 6%, but here we're going to give you access to $3 additional for every dollar that you put into the plan. So we're going to let you borrow that additional $3, but you've got a lot more money going into the plan to work for you. Now, if you think about a 401k, contributions are typically forever, and you're forced to take distributions at 70.5. Here, you only have to make contributions for 5 years because we've got that additional leverage piece making up those excess payments for you. And you can take distributions as early as 15 years without penalties. Now, in either plan, if you need access to it in the event of emergency, you can access it at any time you want, starting in year 1 to whenever. On a 401k, you're typically paying somewhere around 1% of the accumulation value on that account, no matter what the account value is. Here, you are also going to be paying on a 15-year average. If you hold this for the 15 years, your average accumulation charge on that fee is 1%. However, in the 401k, that 1% doesn't provide you any additional benefits. Death benefits and living benefits or illness benefits are going to come out of the value of whatever's in your 401k. So if you passed away, they're going to get the account value of your 401k. Here, that 1% that we're taking out in fees and expenses and charges is also buying them a lump sum of death benefit, and that death benefit can be used for medical needs as living benefits. In a 401k, they're typically offering you some kind of auto rebalancing. Here, we're servicing it annually and we're optimizing it around how much of the upside of the market can we capture, how can we minimize fees and expenses, and how can we stress test to make sure that these designs are going to be there for you when you need them. And if that wasn't enough to convince you how phenomenal this plan is, look what it does. It increases your supplemental retirement income by 60% on a minimum basis, and it provides at least 50% more protection. Now let's look at that. If you had a bonus plan or a deferred comp plan, or you guys, what you were selling them out of pocket today, those are the three that we're talking about here. These are the three comparisons that we're using here, and we're all comparing all of those benefits against Kai-Zen. And what we want to show you here is we took a 45-year-old who's in standard health, and this is a doctor's group, so this is a real case. The employer was providing them $75,000 bonus, and they were providing that bonus forever. We're only going to talk about the next 5 years, not forever, just what they're doing for the next 5 years. If they do anything after that, it's just more money. So let's just focus on the next 5 years of bonus. After tax, those doctors would have $50,000 left over because they're in a 37% income bracket. The growth rate on every one of these is assuming 6.88%, and every one of these we're assuming we can take out the maximum amount between 65 and 90, and then the accounts are depleted. The management fees on these other accounts are 50 basis points, and we assume long-term capital gains of 20% when they're taking distributions. So when we talk about the contributions going into the plan, if you have $75,000 and you have to pay tax on it with a bonus, if you took that bonus money of $50,000 a year and you put it into some kind of stock account earning, or an index fund earning 6.88% rate of return, that's what we're going to compare it to. With the deferred comp, we're going to do the same comparison, but we're going to be able to put it in pre-tax. So over a 5-year period of time, we'll be able to put in $375,000 instead of $250,000. Same thing though with the deferred comp money. We're going to take it and we're just going to buy an index fund earning on average 6.88%. With the insurance product that you guys are selling them, which is an IUL, we're going to do the same $50,000 a year for the next 5 years, and we're going to do the minimum death benefit, minimum cost with the maximum income. And then we're doing the same exact thing with the Kai-Zen. We're just adding that 3-to-1 leverage. Now, let's look at income. What does the bonus provide me if I got to put in $250,000 and earned 6.88% rate of return at retirement. So from 65 to 90, I can take out about $43,000 a year for a total of $1.1 million. On the deferred comp, I can take out about $1.3 million total, or $51,000 a year from 65 to 90, because I'm putting it in there pre-tax. The insurance product gives me the ability to take it out without paying tax on it, so I can get out about $56,000 a year from 65 to 90, which gives me about $1.4 million of income. But I also have the added benefit of that death benefit. And that extra death benefit is going to give me about $1.1 million of death benefit left over, and the ability to access that if I needed it for some type of chronic illness or terminal illness. Now, look at the difference in borrowing the money from the bank and exiting in the 15th year, paying off the bank, and then taking distributions at 65. I can now take $109,000 of income out from 65 to 90, or a total of $2.8 million, and I will have $2.1 million of death benefit left over and living benefits. Now, somebody said to me, what if you don't get 6.88%? Well, that's linear. If I don't have 6.88% rate of return, I don't get it across the board in any of these. The point of this exercise is to show you the power of leveraging. What the use of that additional money gets you is double the benefits if you're a 45-year-old. Now, if you're a 60-year-old, those are going to be a little bit less, so you're not going to double it, right? But you might get 60% or better. And so my number about giving you 60% more income was the conservative oldest age in our group. Look at the difference in these benefits. Now, if you said to an employer, if you had a benefit that looked like this, and your employee wanted to walk away from this, they're walking away from $1.4 million of retirement income, and you're spending the exact same dollar that you were spending before. That is so powerful. I can't even tell you. When people see this, it's just mind-boggling. It's mind-boggling, because nothing changed here as far as the employer is concerned. Nothing changed here. All we did was bring that money to the table. And this is what you guys are selling right now. So if you guys went out and sold the client on what a phenomenal product these index products are, it is phenomenal, but look, it's not that much better than what they're getting in the deferred comp and the bonus plan. So they don't really jump up and down and see that it's that great of a thing. And so you guys have a harder sale than I do. If I came in right behind you and said, I need to use this vehicle if I want to provide 3-to-1 leverage, because if I provided you 3-to-1 leverage here, it's going to be kicking the crap out of the rest of these benefits, right? If I provided you 3-to-1 leverage here, it's going to be kicking the crap out of these other ones, right? But the difference is I can't get 3-to-1 leverage on these because they're in the market and there's too much risk to it. So you'd have to provide a personal guarantee to do them in these plans here. Here, I've got the insurance company providing that personal guarantee. So here's what you're selling them, and here's what you're competing with. Here's what I'm selling them just by adding that additional dollar. That additional $3-to-1 is what's going to allow me to go in and sell away from everybody else selling any other investment. Group qualifications. They need to be between 18 and 65. They need to be employed and getting a paycheck, and they need to be earning at least $100,000. They need to be in good health. Now, when you guys start going after groups, everything changes. When you go after groups, as long as you have 15 or more people, we can get guarantee issue. When you get guarantee issue and you can go to an employee and say, are you in or are you out for this plan? What do you think they're going to say? It makes your life much easier when you go after the groups, because the employees are assuming that the clients, The employers have done the due diligence for them. You're not having to do individual underwriting. You're basically telling them to opt in or opt out. That's it. So it completely changes how much money and how easy these sales are. The other thing that changes is, depending on the size of the group, I may be able to change the minimum participation. In other words, if when you go online and you see one of the individual policies at 1.5 million, I don't have to stick to the 1.5 million when I have large groups. So I may have a group of 100 docs that say, I only want 750,000 of death benefit as a minimum. So I can reduce those expenses because I've got my own group to pool together. So once you start working in the group market, you need to start bringing us those censuses, and you need to start being able to, we need to start saying, we can do this differently, we can do that differently, okay? Now, when you're out talking to the individuals, that's a completely different sale, that's a completely different elevator presentation. And the number one thing that I say to every individual that I'm meeting is, have you saved enough money in your current retirement for you to live the lifestyle that you want to live when you retire? What's the lifestyle that you want to live? What's the dream, right? And what happens to that account in the event that you had a stroke or you have some unforeseen illness or emergency come up, right? What are we doing this for? If the dream is to get to 65 and say, I want to retire on a house overlooking the lake and just live this amazing world, there are several things that can disrupt that dream. First is not having enough money. Second is if you need it in some kind of medical emergency and you either can't continue to earn income or you have to deplete all your accounts to pay for the medical expenses that you didn't know were coming, right? So what I always say to somebody is, what's the dream? Why are you working your buns off every day? And I've yet to have a single person say, my dream is for me to retire at 65 and have just enough money to get by. And I was thinking about also having a part-time job at Walmart, and I just want to live in a $100,000 house and just scrape by. That's not what you hear. What you hear when you ask that question is you're going to hear everybody telling you what that goal is, what their retirement looks like. And then the next thing you want to ask them is, what is the number one thing keeping you from reaching your goal? So you're always going to hear the same thing, not enough money. So I did this exercise with our marketing guy here. And I just went in and I sat down at his desk and I said, David, why are you working your buns off? And he said, well, to make money. And I said, well, for what? And he said, well, to provide for my family and to retire in a comfortable lifestyle. I go, okay, so what's keeping you from doing that right now today? Quitting your job and going to Hawaii and living in a bungalow on the beach. What's stopping you from doing that right now? And he just looked at me funny and he just said, well, money. But that's the answer you're looking for. Not enough money. I haven't saved enough for retirement. I wouldn't have enough in my retirement if something happened to me, and taxes are killing me. I don't know what my taxes are going to be, so when I take distributions, do I have enough money? That's the number one thing you're going to hear if you ask that question to anybody that you're talking to. Now, the number one thing we know is not enough money, and let me put some numbers to this for you. And I show this to each one of these clients. By the way, the elevator presentation for these guys here is, if this is the number one thing that you're concerned about, is that you don't have enough money, would you give me 20 minutes of your time if I could show you how to use the same amount of money that you're already saving and leverage it up 3 times to provide 60% more income in retirement and 50% more protection for you and your family, spending the same amount of money you're currently spending today? Every single time you're going to get, yes, I would be interested in giving you 20 minutes of my time. Now, when you're going through this PowerPoint with them, you're going to recap what I just said to you, because you want them to be in the mindset of, we all know I don't have enough money, right? And just to make this point hit home, let me show you some statistics, because I don't think people actually have ever spreadsheeted this, myself included. When I did this 5 years ago, I was absolutely gobsmacked at the inefficient way I was saving money, and at the lack of knowledge I had on how much I needed to save. So what we did was we went out and we looked at where is the problem for the high income earners. Well, the biggest problem for the high income earners is Social Security isn't going to provide them enough money for them to maintain lifestyle, because the Social Security rate drops, first off, from 25 to 11. And second, Social Security was never designed to supplement your lifestyle. It was designed to provide a very short period of time. People weren't living 20, 30 years in retirement. So, this was always meant to be a short-term gap fill. But if you're 45 and if you're earning 250,000, which, if you're selling individually, guys, you're targeting the people who can afford to pay these premiums. So you're targeting the high income earners. First off, a lot of people don't know your Social Security rate would drop from 25 to 11. That's assuming you even think you're going to get Social Security, but we'll come back to that in a minute. As a result, doesn't matter who you go talk to, everybody is saying the same thing. If you are earning a 5% real rate of return and you're 25, you need to save 13% of your income. If you're 30, 18, 35, 24, and 40 and over, 34%. Now, Fidelity tell you 30, Merrill Lynch might tell you 25, but they're all in a range that is way above the current savings rate. So just so you guys know, and I don't have this on the chart, but just stick it in the back of your mind somewhere, the average American is saving 5%. The average high income, doctors, attorneys, CPAs are saving 9%. They are very, very short of what they need to save. Let me show you what that number is. If you're earning $250,000 and you're 45 years old, they're telling you that you need to sock away $85,000. That is a huge, huge number. And that's a number most people are not able to set aside, or not doing it now, or don't want to do it. Now, the other big problem is the average person out there retiring today doesn't even have $250,000 in savings. So 83% of the American people that are retiring today have not saved even $250,000. That means only 17% of the people have saved more than $250,000. Why is that important? Because there is not a single financial advisor or organization out there today that isn't saying that your medical expenses aren't going to be averaging $275,000. So if you haven't even saved $250,000 for retirement and you need at least $275,000 for medical expenses, what are you living on? And if you think that's not you, everybody knows you have a 70% chance of needing long-term care services. So if you think that's not you, and 70% of us are going to need that, you should be at least making sure you're covering that. And also, a lot of people have the perception that this is something that's an old person's disease, and it's not. 40% of the current 13 million people receiving long-term care benefits are between the ages of 18 and 64. Why? Because most people think long-term care means stroke. And most people think stroke means old age. They're not thinking about all the people that have been in car accidents and are paralyzed. Those people need long-term care treatments. They're not thinking about all the people that may have lost a limb or, gotten cancer or whatever. There are other people that are using long-term care facilities. My sister has MS. She's 57 years old and she's in a nursing home for the rest of her life. She's 57. She's been in a nursing home for more than 10 years. So the point is that you have to think about this from the standpoint of today and protecting you and your family today, not just when you get to 75. And how long before your savings account or your retirement account would be depleted if you got MS today and needed to go into a nursing home. I can promise you, before you actually were allowed to be sent to a nursing home, your accounts would have had to have been depleted before you're eligible for Medicare. So you couldn't have a dime to your name before you could get coverage at a Medicare facility. Now, I'm not saying all these things to scare you guys. I'm just trying to put it in the perspective that most people don't think about these things, myself included. And if all of that wasn't on the minds of everybody, tax erosion is, and a lot of the tax erosion is because it's in the papers every day, and it's on the internet every day, and it's the politicians talking about the debt. And this is an ongoing conversation. But here's the problem for the average person out there. When you're a doctor and somebody tells you you're getting a $100,000 bonus, that's the number that sticks in your head. And you go out and you spend and you buy your cars based on that 100,000. What you're not thinking about, because thanks to automation and thanks to all of our paychecks being sent direct to our bank accounts, after taxes, that's $60,000 you're actually taking home. So I am so guilty of this. I remember somebody would tell me what my bonus was, and I was all excited, and I went out and I started spending that bonus. And then I'd look at my account and go, what the hell happened to my money? So I went in and I sat down and I talked to my CFO, and I was like, what the hell happened to my money? Did you not put it all in there? He said, of course I did. And then he tells me the amount. 60,000 is what I deposited. And I'm like, why 60,000? He said, well, you're forgetting about taxes and FICA and Social Security and all the other things that come out of your paycheck. And I was like, oh my God, I know that. I know that. I know what tax bracket I'm in. I know I pay FICA. It just never dawned on me. It just didn't register. My brain said, you just got a $100,000 bonus. And that's what I was out spending. It never dawned on me to calculate in my head, minus this, minus that, this is what you really ended up with. And here's the real problem. You got that 5% real rate of return. By the end of the year, you're only back to 63,400. It's going to take you 7 to 10 years just to recover back the tax erosion of that $100,000. So the real reason that we have a problem in you trying to get part of our wallet is because our wallet just got walloped by 40%. It had nothing to do with you. And now we're in our minds trying to figure out, I just took a huge hit. How do I make that back? And so this is a great way for you to be able to say, look, you did have to take that huge hit. But if you now take that 60,000 and put it into our plan, we can leverage that back up to 120. So you at least get to make money on the money that you lost in taxes. So this is a great tax erosion vehicle to help you recoup some of the invested return that you would have gotten on that money had you had it in your account. And here's a bigger problem for taxes. What are the real tax rates going to be when you retire? Do you guys remember when the first time somebody talked to you about your 401k or your Roth or whatever? Put your money in this, and by the time you retire, you're going to be in a lower tax bracket, and so you'll have a lot more money to spend. Well, if you think about that, Social Security is due to run out of money by 2022. Somebody told me the other day, well, they're going to prolong that now to 2028. I said, who cares? Because all they're going to do to prolong that is reduce the amount that they're giving out and increase the age at which you can take it. The point is, you have a pot of money. Whether you stretch that pot of money out by reducing benefits or extending the time period before you could take it, it's still the same pot of money. They're gonna run out. Medicare is due to run out of money in 2026. The government debt expected to be in 2027 is expected to be 120% of our GDP. So what do you think that the government's gonna have to do to shore those up? And if you are listening to ITR, which is an economist that has a 94% accuracy rate, they said that we're headed for a Great Depression by 2030 because we have the largest baby boomers going out. We don't have enough tax workers coming in. Social Security is due to go broke. Medicare is due to go broke, and the government can't bail out anybody else. And if you start to think that these numbers are starting to sound similar, it's because you're due to retire in 2033 if you're 45 years old. And what did the Congressional Budget Office say that you need to do to shore up just Social Security and Medicare? They said we need to double the marginal tax rate for every category across the board just to protect Social Security and Medicare from running out of money. That has nothing to do with the deficit. That has nothing to do with any kind of Great Depression. And so what I would say to you guys is, here's what is happening to each individual client that you're meeting. They've got investment advisors calling them, telling them that they need to invest more money in the market so they can get more growth. They're also got guys calling them, telling them they need to set aside 6 months worth of expenses to cover any foreseen emergencies. They've got people trying to sell in life insurance. They've got people trying to sell them disability insurance. They've got people trying to sell them long-term care, all while they have this amount of money that just came out of their paycheck. And again, what is the ongoing theme of everything that we're talking about? Not enough money. Who's going to provide the money that we need to fund our retirement gap? 84% of working households today fall short of funding their retirement based on total financial assets. That's everything that their house is worth, their cars are worth, their jewelry, their gold, and whatever else. The government is not going to bail us out. They're going to be so far in debt, they're not going to know how to solve that problem. And our employers are already spending 40 to 80% of gross revenues on employee benefits. They can't increase what they're doing. So who has the solution? We do. We are offering these people the one thing that nobody else can offer them, and that is the use of more money. We can provide for them more money, providing them more death benefit than they can purchase on their own today. We can provide that death benefit so that they can use that and have access to that cash in the event that they had some kind of chronic illness or terminal illness. And we can provide them more than what they can get on their own. We can provide them a platform that will allow them to take our money and use it to get upside growth in the market without market losses. So they're not at risk of losing their own money or the money that they're borrowing. We can provide them tax advantages that they can't get in any other vehicle. They can not only grow that money tax deferred, but they can also access it tax-free. What other plans are offering these types of benefits? And here's the most important thing about the difference between what you and I are out and able to offer to your colleagues, your friends, your family, and your business associates: the leverage. More money going in means more money that you have working for you, which means more money in retirement and more protection for your family. And you are not limited in how much you can put into this plan, and you only have to do it for a minimum of 5 years. So you can set goals for 5 years. That's simple, that's easy. I've already done my 5 and I started a second one. They are really quick. I couldn't believe how fast 5 years went by. Every single one of the dollars that's put into this plan, they're going to get the use of 3 additional dollars. You're not getting that in anything else that's on the street today. And you get to use that money for the next 15 years. How much money could you make in the market if you had the use of 3 additional dollars over the next 15 years? I would say a lot. And the amount it's going to cost you to borrow that money is 1-year LIBOR plus 1.75. All in today, guys, that's about 3.4, 3.5. Now, here's the most unique thing about this particular leverage. There are no loan docs, there are no personal guarantees, there are no credit checks, there's no financial underwriting, and there's no interest payments on an annual basis. And I need to add that as a bullet point. There's no loan docs for the employer. There's no personal guarantees for the employer. There's no credit checks for the employer. There's no financial underwriting for the employer. So keep that in mind when you're also talking about the group benefits. How is that possible? We are taking the contributions that the people are putting into this plan, and we're using those contributions as the sole collateral for the loan. So when you guys go online If you're talking to an employee and you said to an employee, if you had this type of a plan accessible to you, how much would you put into this plan? Make them give you a dollar amount. Let's assume that they told you, I'm a 45-year-old male and I want to contribute $50,000 to this plan. Go online on the NIW website, pull up a 45-year-old male, this happens to be Standard Health, and look at the minimum contribution. Okay, the minimum contribution on our plan, I could tell you off the top of my head, is $32,000, but this client told me they wanted to put in 50. So I went to the $2 million example and I said, hey, if you put in 50,000, that bumps the death benefit up to 2 million. So you can use this illustration or sample to show them. Guys, please stop selling based on illustrations. Please stop showing them spreadsheets. Clients' eyes bug when you start showing them spreadsheets. And another thing that happens to them is they expect what you're showing them on those spreadsheets. So here's what I do that's different. When a client tells me, I say, look, if I gave you access to 3-to-1 leverage and I gave you a 0 floor so that you can't lose the bank's money in this, my contribution is covering cost of insurance, and that cost of insurance has been dialed down to look more like a buy term invest the difference, right? So if I provided you a vehicle that gave you the tax advantages, the upside growth without the market risk, and it gave you that 0 floor so that you could never lose the bank's money, what's your risk on this transaction now for that 3-to-1 leverage? Your borrowing cost. That's it. And if I can pull people together and get my borrowing costs down to 3.5, I can outperform this loan very easily. Now, I can show you how they can outperform this loan, and I can show you how this plan works in a Great Depression and a high interest rate of the 80s, and I'm going to show you that in just a second. But basically what I say to a client in summary here is I say, first off, if I provided you a 0 floor so that you can't lose the bank's money or your money, and I provided you 80% of the upside of the market, and I allowed you the tax efficiencies of this account, how much would you want to contribute? Get them to tell you a dollar amount. Then go look it up online. If they said $10,000 and I knew that the minimum one for a 45-year-old is $32,000, I'd say, I'm sorry, you're not eligible for the 3-to-1 leverage, but you can still do this index policy. So you guys as agents can still sell them the index policy on your own and still get a commission. However, 90% of the people are going to say, well, what is the minimum? And I'll say 32,000. They'll either tell you, well, I can't afford that, at which you'll say, okay, well then you can still do the plan. You still have all the features and benefits. You just don't have the use of the 3-to-1 leverage. Or they'll say, I can afford that. Now, if they tell you I can afford that, then you want to basically say, look, the problem with illustrations on these designs is I don't know what the market's going to do. And so the insurance company requires me to take today's rate and look back over the last 20 years as if you already had this plan. And I have to use those numbers to illustrate. So if history going forward looks like the last 20 years of history in the past, these are some assumptions we can make. If you put $50,000 in a year and you have the bank's money of $996 added to your $250,000, you would be able to take out, you pay off the loan in the 15th year, get out of the design, and you'd be able to take an income around $109,000 or $2.8 million of death benefit. Now, how does that compare to what you were doing with your own money? $1.4 million is all you'd have available to you with your own money. You'd still have a death benefit of 2.1 here, and here you'd have a death benefit of 1.1. Now, these are the initial death benefits. By age 100, those obviously grow, and this is all after you've taken out this income stream. Now, if they say to you, run this, what did you run this at? And you said 6.88, and they go, I don't believe you're going to get that rate of return, then you say, great, it doesn't matter. The reason it doesn't matter is because on every single design that we do stress testing. So you're right, Mr. Client, I have no idea what the market's going to do. But what I have done is they've gone back in time and I've looked to see what would be the worst time period to ever be in the market. And I'm not just talking about this product. I'm talking about being in the market, being in the S&P or tracking the market or being in stocks, and that would have been during the Great Depression. Now, you got to remember, we're tracking the same market that you're in if you're invested in your 401k or any other retirement account that you're using. We're tracking the same S&P. So if the market goes down for you in the 401k, it goes down for us in this design. If the market goes up for us in this design, it goes up for you in any other stock portfolio, right? It's the same S&P. It's the same euro. It's the same Dow. We're tracking the same identical market. So whatever assumptions you want me to make on this plan, you have to make those same assumptions on your 401k or your brokerage account or any other investment that you're investing in the market. I don't know what the market's going to do. So let me show you. If we were in a Great Depression, this design would not have to be called. I wouldn't have to ask, you wouldn't have to put more money into it. The bank wouldn't take their money back. The design would ultimately recover, and you'd still be able to take out an income stream of $74,000 from 65 to 90. So instead of the 109 we're illustrating, it's 74. Did you stress test your 401k to see what your 401k rates of return would have been? Have you stress tested your brokerage account to see what that would have been? Are you guys stress testing with their own money what that would have been? And I can tell you it wouldn't have been $56,000. It would have been around $23,000 or $25,000, somewhere around there. I don't remember the numbers off the top of my head. But the point is that even in a Great Depression scenario, it's better than on a 6.88% rate of return with their own money out of pocket. Now, the other thing that they always want to know is what happens if interest rates go up to where they were in the 1980s? Well, if interest rates go up, we've designed it to go all the way up to 17%. We kept the cap at 15%, even though we had unlimited upside growth during that time period. So our stress test on the borrowing money is even more conservative, and we're still going to deliver $93,000. We didn't have to call the loan. We didn't have to ask the clients to put in more money. We just left it like it was with the same contributions, and they still were able to get $93,000 a year of income out versus the $56,000 they were able to get with your plan. And remember, the bonus in the market and the deferred comp in the market were very similar to these rates of return. So I'm beating those also. This is all you need to be talking to them about. I don't know what the market's going to do. Unless we have something worse than a Great Depression, you can assume that your worst case scenario from a product performance, you'll be able to still get $74,000 of income. But keep that in context with their other investments, Mr. Client. What would have happened to your stock brokerage account? From the high interest rates, we don't care what the interest rates go up to. We even cap the plan at 15% returns of the market, and the design still works. So there is nobody in the country that is stress testing 401ks, bonuses, deferred comps, or self-funded IUL. So from the standpoint of providing them a better benefit, providing them more protection, providing them more certainty that they'll have these benefits available to them, we've checked every single box when we're talking to these individuals. Now, guys, we have a lot of backup slides, and we'll get into those in a minute. But first, let's talk about the individual qualifications. They need to be between the ages of 18 and 65. This is not grandparents buying this on their grandchildren. The plan was developed for business owners, business executives, employees working for businesses. So please don't go out and talk grandparents into buying this. Where you could talk grandparents into buying this is you might say, look, client, if I'm in the annuity market space, I might go to my annuity clients and say to them, hey, what does your son do for a living? Well, he's a doctor. Oh, I've got a plan for you that you should convince your son he needs to participate in. That's where you want to get your leads from your older age market, but only for the people that are earning the income that have the ability to participate. You know how many older retired people want to talk to you about their kids and what they're doing? Spend an extra 5 minutes with them to find out who are your kids, how old are your grandkids or your kids, and where do they work? Because you can really quickly find out if they're a doctor, they probably are going to qualify for this plan. If they're an attorney, they're probably going to qualify for this plan. If they're a CPA, they're probably going to qualify for this plan. So if you want to use that as a way to go out and try to get some referrals, that's a good source for you, but please don't make this available to people that are earning less than $200,000. Why? Because they can't afford to pay for the minimum premiums that we have online. If you're a group, you can go down to $100,000 because your employer is going to be helping you with those contributions, and therefore, if you lose your job and your contribution is $32,000 a year, you lose your job that your employer was providing this benefit and you're only earning $100,000, you can't afford to pay for this. Now, I don't mind losing a few employees that might go somewhere else on a group plan. It's not going to affect my persistency, but if I had 100 individuals on this plan and all 100 people lost their job and they all couldn't afford it, then my cost of borrowing would skyrocket. So please qualify your individual clients, and please don't make this available to people that earn less than $200,000. How do you want to use that? If you're selling to individuals, use it as a prospecting tool, use it as an additional revenue stream for what you're already successful in. If you're successful in the retirement market selling annuities, don't try to deviate from that market. Just try to enhance what you're already doing by making this an additional arrow in your quiver. Offer this as an alternative asset class if you're a registered investment advisor. Think about the competition that you have right now. I'm securities licensed. I'm the principal of our broker dealer. Anytime I'm talking to somebody that's talking to me about investable assets, I always say to them, the number one thing that people are selling today is stocks and bonds. Put 60% of your money in stocks, 40% of your money in bonds. That's the old mantra. Whether it's 50-50 or 80-20, that's the typical sale. Let's use this as a third alternative asset class. You're not going to get as much as you are in the market. You're not going to get as little as you would in the bonds. This is right in the middle. This is going to give you on average 80% of the upside of the market, but it has a little bit more risk than a bond portfolio. It's a third alternative asset class. So use your market and what you're doing for a living to figure out how you want to use this as a tool to enhance what you're doing. If you're in the group space, you should be going out and capturing the deferred comp market. You should be going out and capturing the bonus market, right? Because if I'm paying somebody a bonus of $100,000 a year, it is not cost effective for me to pay them that money and then have my competitor offer them another $5,000, because the day that they get paid that bonus and somebody offers them a higher paying job going down the street, they're going to wait and collect the bonus from me and then go take the job anyway. How did that help me with retention as a company? It did nothing. But if I'm making the contributions into this plan for an employee and they walk away from it, they're walking away from, as my example of this 45-year-old, over $1 million of retirement income because I'm no longer making these contributions into this plan for them. And in fact, if I set up a vesting schedule, they might end up having to pay me back some of the money I've already contributed. So you can use this as a much more efficient retention tool as a company. If you think about what's going on with deferred comp, before the tax change in deferred comp, for every $100 that I spent on my employees, I was getting a $35,000 deduction for that because it was compensation. So if I spent $100 on that doctor to give him money, that means that when I paid him that bonus, I got a 35% deduction. Sorry, when I did that deferred comp, I got a 35% deduction. So it cost me 65 cents on the dollar to provide this benefit. What does it cost them now? 79 cents on the dollar. So the same plan that I was offering pre-tax change is now costing me 79 cents. So I now, as a firm, have to spend a lot more money to provide that same deferred comp benefit. Guess what? Companies are trying to figure out how to get out of the deferred comp plans now. You have a solution. Go convert those deferred comp plans into this plan. Who are you targeting? Highly skilled. These are the guys that are business owners. So they've spent so much time investing back into their company, they haven't done anything for themselves, or they had to wait until they were profitable or successful before they could start saving. And now they're trying to play catch up. And they don't have a lot of options. Business owners, doctors, dentists, financial advisors, technology guys, engineers. And here's that chart that I was trying to show you earlier. And this one is for the Allianz Commission. And guys, remember, they're not different, right? They're all about the same. So look, here's this doctor, this 45-year-old doctor. This is a real case. This doctor puts in 50,000. We leveraged it up to 100. The target on this case was $25,000. So even with your 70-30 split with NIW, you made on average about $7,000 per guy you signed up. So if you do 12 of these a year, you made $89,000 in first year. But guess what? If you only did 12 more next year, you're making 178. Why? Because this is spread comp. So you get the 89 from the previous year client, and now you've got 178. If you sell 12 again the next year, so by year 3, you've signed up 36 people. You're now getting $267,000 of income. And by year 4, you're at 357, and by year 5, you're at 446 of income coming in each and every year before you have to wake up and do anything else. Now, I capped it in year 6, so you've only sold over the last 6 years 72 people. You just got a paycheck of $535,000, and you sold nothing in year 7, nothing in year 8, nothing in year 9, or any year after that, and you still got a check for $710,000, and you getting renewals now. You still got a check for $885. In year 9, you got a check for $1 million, and in year 10, you got a check for $1.2 million. And I didn't even go beyond that because the way the spread comp works, if you were in all the guys that you sold in year 5 and 6, you still have residual income. The point of this exercise was I was trying to show you that you've made way over $1 million, but now you're taking home $1 million a year by the time you've signed up 72 people. That's after you took your 89, your 178, your 267, your 357. This is your paycheck. So guys, this can be a very, very profitable book of business. Very profitable. And for those of you who don't like spread comp, if you went out and you were taking all your commissions up front, and your goal was the same as everybody else's here, you want to make as much money as you can and sell your business and retire and live the dream. How much are you going to sell your business for if you've stripped out all the upfront comp? What do you think you could sell your business for if you had this residual income? And if you had a proven revenue stream that these people were not only staying in these deals for 5 years, but you could prove to the buyer that more than 50% of these people were re-upping, signing up their business partners, signing up their business employees, signing up their spouses, because we're tracking that data for you. So we could help you, show you how to sell your business for much more profitable rate of return than what you could currently sell it for today. So this is a really good business plan for you. And if you're going to do this, guys, don't do this if you're only going to sell one case. There's no point in you guys signing up. There's no point in us signing you up. This is something that you guys should be doing if you want to make a commitment out of it, because it's not cost effective for us to spend our time and energy training you if you don't want to make a commitment. Nobody's going to make money by selling one, right? Unless you're adding it to your existing book of business, that's fine. But if you make this a one a month, that's your goal, or one group a year, that's your goal, you'll make a lot of money out of this, and it'll be cost effective for all of us, and it'll be worth all of our time. And by the way, guys, in the 30 years that I've been in this business, I have always wanted one thing and only one thing, something nobody else had. And we have that. So you have the opportunity right now to go out and sell something that nobody else has. Why does nobody else have that? Because NIW has figured out how to take the previous 19 years that we've been in business doing these plans for our high net worth clients. So we've already facilitated 4.7 billion. And because our persistency on that high net worth market is 99.63, we've been able to go back to our 14 lenders and convince them that we will monitor this in the same way that we designed those high net worth clients. We will strip down the fees and expenses and charges so that it looks more like a buy term, invest the difference, and we will focus the bank's risk on the cash that's in the account, not the death benefit, the cash. And if you design these correctly, you have Todd Pettit, the actuary of Allianz, said, you have a higher probability of getting struck by lightning than not being able to outperform the loan cost in the way that we have designed these plans. Now, I'm not going to give you the videos, but basically you can go to the insurance companies and you can show your clients on how index products work. But really what NIW has done is we have focused on maximizing the growth and minimizing the cost. So that's the reason we have to do spread comp. If we don't do spread comp, there isn't enough money in this plan to secure it for the loan. So if you want to design this differently and you want to do higher targets and you don't want to do spread comp, then you're back into traditional financing. And that means that the client has to go through financial underwriting. They have to provide credit checks. They have to provide personal guarantees. They have to sign all the loan documents. We've been doing that for 19 years. If you want to do that, that's our bread and butter. We can do those cases as well. But if you want your clients to be able to participate without the loan, without the personal guarantees, without the underwriting, then they have to do this. We optimized around these costs. And in the way that we've optimized and reduced fees and expenses and charges, if we max fund these, excuse me, for a 10-year period of time, and the client holds these over a 15-year period of time, we can get the cost, and I'm talking fees, expenses, charges, mortality, everything. Clients' death benefit, living benefits down to less than 88 basis points of this accumulation value that's in the account. That's really strong. What that allows us now to do is take advantage of the tax advantages of life insurance policies so that we can grow the money tax deferred and we can take it out tax free. We can eliminate the market risk, which means we can leverage without the risk of losing the client's money. Now, the way that the cash inside the policy works is it all goes into the general account of the insurance company. So the insurance company is providing the protection for us, for our lenders. Every single insurance company is putting that into an investment grade fixed account, and they are declaring some type of interest rate. Let's assume that that interest rate's 5% today. That means that when we get into this plan, we can choose the 5% interest, but that's not the way NIW is designing it for Kai-Zen. What we're doing with Kai-Zen is we're saying we're going to give up our 5% fixed rate. And we want that insurance company to use that 5% fixed rate they were gonna pay us, and we want them to purchase an option. What does that mean? That means that all my cash now is sitting in the account and it cannot be lost because it's principally protected by the insurance company. So my bank loan is secure. The money that they were going to pay me, the interest on that account that they were going to pay me, I've given up. I've allowed them to go purchase an option on the S&P. Once that option is purchased, they can't get it back. That money has been spent. The insurance company gave it to the options desk. It's gone. So you have to wait until the end of the year, until the anniversary 1 year later, to find out what happened in the market. So if the market from January to January 2018 to January 2019 goes down by 20%, you'd purchase that option, the market went down, your option expires worthless. You lost your 5% fixed return, but your principal is still in the account. So your bank money never got lost. Yes, you have to pay to borrow that money from the bank, so you've got a little bit of a interest rate risk that you have, but over time, we know we're going to be able to recoup that in the market. As the market goes up, we're subject to caps. My $5 or my 5% interest would only buy me today 12% of the upside of the market. If I had 6% money to buy an option, I might be able to buy 15% of the market. But in today's environment, that means that if the market went up by 20%, I'm going to exercise my option, I'm going to take my growth, and I'm going to deposit that 12% back into my cash account, and that's my new principally reset balance. Why? Because I took that $11.88 and I purchased the investment grade bond portfolio, so it's now protected. I can't lose from an investment risk standpoint this $110. And then we start again. What makes this strategy so much better than everything else out there? Leverage, right? If you went out and paid cash for a house today, you'd probably have to buy a house that's worth, let's call it $200,000. But if you use leverage, you could go live in a house today that's worth $1 million because you're borrowing the money from the bank. I'm going to do the same thing. I'm going to take that money from the bank and I'm going to get more of a death benefit, and I'm going to get the use of that additional money so that I can get more for my retirement. How does it work? The client contributes for the first 5 years, or the employer. Doesn't matter if it's the employer paying the contribution or the employee or the two of them combined. Maybe the employer says we're going to contribute $25,000 and the employee says I want to contribute $25,000, right? So together the employee and the employee might be putting in $50,000, and then the bank matches those amounts each year for 5 years. At the end of that 5-year time, they're done. No more contributions are required. They can start a second one if they want, but now the bank takes over and makes both payments. That gives you 1, 2, 3 to 1 leveraging. So what ends up happening is when I'm making my contributions over the 5-year period, or when my employer is making those contributions, my money is covering costs and fees and expenses and charges, right? Anything over and above those costs and fees and charges of my money is going to be going into the account to get growth. That's the same thing you guys are selling them right now. So if they put $50,000 in with you guys, that $50,000 is covering costs, fees, expenses, and charges, and all that excess that's going in there is getting growth. Now, the bank money is going straight into the cash portion. I'm going to use that money for 15 years, and then I'm going to either withdraw it from the policy. I can withdraw at a cost basis if I choose to do it that way, or I can use a participating loan, or I can do a fixed loan. We don't care. Or I can use outside funds if I want to do that. We've shown a participating loan here. That means they let the money grow until they're ready to retire. And that could be, by the way, guys, they can take distributions anytime they want. Once they loan exit, they can start taking distributions here. That would be 60 years old. But if they let it grow to retirement age, in this example, they're taking out $135,000 of income a year from 65 to 90. Does this sound too good to be true? Well, think about chocolate. It was created in 1847. Peanut butter was created in 1895. And 33 years later, Mr. Reese combined chocolate and peanut butter and took those two well-established individual companies that had nothing to do with each other, combined them together, and launched the #1 selling candy brand in the United States. So think about that in terms of what we've done. We have taken a bank loan and eliminated the loan docs, the personal guarantees, the credit checks, the interest payments, and we have combined that with the cash inside the life insurance policy, not the death benefit, but the cash. And now we have the opportunity to make Kai-Zen the #1 executive benefits in the United States. When your clients think about borrowing, you need to get this point across to them. Typically, when you go to the bank and you ask for a loan, you agree to provide collateral. Think of your house, your car, your business receivables, whatever it is, and you agree to make payments and interest on that. However, in this design, we're designing it more like a margin loan. In a margin loan, you can open up a brokerage account, you can deposit $100,000 in that brokerage account, and then you can use the cash in that brokerage account as the security for a loan. Now, if I am a bank and I give you $50,000 on that margin loan, that means I'm expecting your $100,000 to secure it. The only reason they need personal guarantees is because the market could sell away from them, right? But if there was no market risk, would I need a personal guarantee? No, because I'm not using a security here. I'm using the cash value of a life insurance policy. All right, so I'm not going to get into the differences between a margin loan and this loan because I think you guys get the point. And really, this was designed for training purposes at the university. But we've now been able to show you why are banks doing this for NIW and nobody else in the country. Well, there's several things. First, since inception, since NIW has started, we have been optimizing our designs around highest growth, minimum cost. And so we have, and we've stress tested every single one of our designs for the banks through Great Depressions and through 1980s interest rates. But there's some other things that NIW has been doing. We've been tracking our rates of return in our servicing. So if we illustrated to a client 15 years ago that we were going to be doing this type of a design and here's what it was going to look like, we track that every year for our clients in servicing. So we say, here's what we originally illustrated and here's how we're performing to plan. So what that has given us over the years is the data to say, has these designs been working? Are we getting the growth we said we were going to get? Are we outperforming those loans we said we were going to outperform? And what is our persistency? How are they working? Have our banks lost any money? We have not had a bank lose any money. We have had every single one of our banks secured in their loans. Our clients have the luxury of being within 5% of where we illustrated we were going to be. And we have already facilitated over $4.7 billion of these types of loans. So when we went out to the insurance companies and the banks to do this, they were very confident in our designs because we're showing them that we're already doing these stress tests that we said we were doing before. And I already showed you these numbers earlier. But just so you know how conservative we are, during the Great Depression, our average loan pricing was 2%. Not unlike it's been for us in the last 5 years in the United States. Also, we had unlimited option upside growth in 1935 and 1936 and a few of these other years because our bond performance was higher. And those numbers are being given to us by the actuaries of the insurance companies. So they're not our numbers calculating this. But we were conservative. We went in and we capped it at 12.25 and we increased the loan rate to 4. So the designs still work. We might have to stay in the loan a little bit longer just because we want to optimize performance if we're using this conservative, or we might get out a little earlier. The point is we don't have to call the loan. We're delivering what we said we were going to deliver, and we've stressed it through the worst economic time period this country's ever experienced. Same thing with the interest rates in the 80s. Here's the numbers for the interest rates in the 80s, and you'll notice that we kept today's cap rate at, by the way, the cap rate at the time we did this was 12.25. We kept the cap rate at 12.25, and we kept it that way for 4 years. We didn't increase the cap until the fourth year, and we only increased it by 1 percentage point. So we only took it up to 15, and we kept it at 15. Now, anybody knows that if we had these kind of bond yields inside our portfolio, we had a much higher option budget. So we were getting more than 12.25% of the upside of the market. We were getting more than 15% of the upside of the market. And we know that, we have it documented. But we are conservative. We left the cap at 15. We let the interest rates go up to 16.88%. And these designs still worked. We still got out. And we showed you on each and every illustration, this illustration, we showed you what those numbers were. Oh, this is the illustration, right? So we showed you on here what those numbers were. There's the stress test for the 80s. There's the stress test for the Great Depression. Now, who's participating in this plan? Everybody. There are the largest executive benefits companies in the country have signed off on this plan and are out selling it. We have medical people in this plan. 21% of the people participating in this are medical. However, this is what says something to me. If you're a financial advisor, you're an attorney, you're a CPA, you're a licensed insurance agent, you're a hedge fund manager, a registered investment advisor, an employee of the insurance company, that makes up these groups here. And what's interesting about that is, you know, when an agent buys something on himself that he believes in it. But what's even more amazing is look at these designs here. This is actually the head of one of the top 10 United States private banks that's participating in this plan. If you knew how many executives and employees of the banks that we're working with were in this, it would blow your mind. And that to me says it all. And this is mine. So for those of you who want to be able to say to your client, and I've had plenty of clients ask me, are you in this plan? Yes, I'm in this plan. I was the first one in this plan. This plan was created for me selfishly. I wanted this for myself, and I wanted it for the employees at NIW. That's the whole reason we created it. We didn't create this to take this out to the marketplace. We created it because we wanted to participate in what we were doing for our high net worth clients, but we didn't have the same income level that they did. So we had to come up with something for ourselves. Once we created it, people started coming to us saying, wow, look what you created. Can we participate? So if you look at what my rates of return are, I had 13% in year one of my policy, and I had a borrowing cost all in of 2.75. In year two, 7.5 was my credit, 2.75 was my borrowing cost. In year three, I had a 0% growth, and my borrowing cost was 2.75. In year four, I got a 12% return. My borrowing cost had gone up to 3.15. In last year, my borrowing cost, my credit was 12.5, my borrowing cost was 3.5. Let's take the 5-year average of that. That means, see here, we tell them here, here's my 5-year average. Here's my 5-year borrowing cost average. That means right now I have a 6.01% spread. Guys, in order to make this work, I need about a 1.5% spread. Anything over and above that is additional money that I can have for retirement. Here's my second one I started. The first one I did as a Kai-Zen. The second one I did as a Tri-Zen. The difference between the two is nothing other than the way I'm paying for it. So here I had to put it in with an after-tax dollar. Here I borrowed it from NIW, and so I got to put it in with the pre-tax dollar. So now instead of contributing $32,000 after tax, I contributed $58,000 pre-tax. What does that mean? That means I get to leverage 60,000 instead of 30,000. Wow, that's pretty cool. I've almost doubled what I can leverage, which means more income in retirement, more death benefit, even after I get out of the design and pay back the employer. However, my last year credit was 6.64. My borrowing rate was 3.59. There's nothing like this, guys. There's nothing like this on the street. We have been able to show people how to provide more protection, more money, and more confidence than anything else that you're selling today. So when it comes to them being able to live their retirement dream, you have the one platform that allows them to live that dream, and that's Kai-Zen, adding more money. Okay, with that, if you have questions, guys, please raise your hands. For those of you who don't have the time to stay on for question and answers, thank you very much. Have a fantastic weekend. We're very excited to work with you. For those of you that have questions, I need you to do a couple of things. First off, there's a dial-in number, then there was a passcode, and underneath that was a little 2-digit PIN number. If you haven't inserted the PIN number, I won't be able to unmute you, so I can't answer your questions. So if you make sure you do that before we start getting the question and answer section. So please raise your hands if you have any questions, and we'll kind of walk through those. I'll unmute you. Jeffrey, Marsh?
Yeah, just a quick question. For groups that are not taxed as a C Corp, that want to participate as a group, and you had 10 employees that were participating, other than having some type of vesting agreement, which would be a side agreement, not related to the documents for Kai-Zen, if you had an employee that left after 3 years, that policy, I would imagine, is somewhat portable. How would you keep them from leaving, or deter them from leaving, or make it more difficult if you didn't have a vesting agreement?
Very simply, I've got an employer right now that has agreed to make these contributions for me. I'm in year 1. They made my $32,200, and now I'm thinking about leaving. Who has to pay the rest of those 4 years of $32,200?
Well, it would be the individual, or if you went to a different company and they picked up, that
Correct.
payment.
But before you go to work for that different company, you've got to convince that different company to pay that $32,200 so that you can keep that benefit. So from my standpoint, and I know this, from my standpoint, if I walk away from this, I know I have to go convince somebody else to pay it for me, or it's coming out of my pocket. That's a pretty big incentive. My thought process, and this is just me because this is the way I think, I'm an owner of NIW, but I'm also an employee. So my first thought process was, if somebody came in here and decided, our partners decided we're not going to make these payments anymore, my first thought process was, I need to stay here at least 5 years before I go find another job, because I want these payments to be made, and then at least the bank goes and picks up the payments after that. So it's going to be really difficult to convince me in these 4 years, 5-year period of time to walk away. I want to secure those payments. Now, if my new employer tells me that they'll do that, that's great. But it's got to be on the same terms and conditions as what you've set in place here. And that might be a referral for you to go in and talk to their company. But most people that are looking at going to new companies don't have the ability to be negotiating that kind of compensation package.
Okay.
Right? They might say, hey, I'll pay you the 32 but they don't have access to Kai-Zen. So, that employee might think, great, okay, well, I can do Kai-Zen on my own now, but my other employer was going to keep making, and I could have leveraged up and done another one in the next 5 years. So, you can say to the employer, what's important to you? Now, think about it from a business perspective. Most businesses, big businesses especially, are thinking in 5-year increments. The goal of those big businesses is to grow their business for the stockholders, or to grow them and to sell them, right? And so if you're thinking in 5-year increments, you want to secure your employees for the next 5 years. And then let's do a new plan, right? Do I need to secure them again for another 5 years, right? Most of the guys right now have been doing these forever. I'm going to give you this benefit and it's going to be, you're 45 and I'm going to give it to you till you're 65. And that's a very, very difficult conversation for most employers to have. The other thing employers could do to tie their employees is say, I'll pay half, you contribute the other half, right? So maybe they make it an incentive that way. There's all kinds of creative things, but that's for you to kind of work out with that employer how he wants to set it up. If they want to set up a vesting schedule, then they might say, we'll put in all 32,200 for you. And over the next 5 years, you'll have all 32,000 in there, but you're only vesting at 15,000 a year. So by year 5, if I put in as a company 160,000 and you're in year 6, you've only vested 90,000 of that, you got to pay me back the difference. So one of two things is going to happen. You either have to cough up $70,000 to pay me back, or you have to go in and cash in this plan, because you can't access that cash to pay me back until you pay off the lender. That means you're out. That means you lose the other 6 years of 100% financing. That's a huge benefit.
Yeah, I agree. Thank you.
You're welcome. Have a great weekend.
You too. Octavio, is that it? Octavio Leon? Hello?
Hi,
What's your question?
I don't have a question.
Oh, you had your hand up. Okay, sorry. Okay. Robert Duncan,
Hi, Grace. Can you hear me?
I can hear you.
Hi, Grace. Great presentation as always. I just wanted to offer another data tip, maybe if you want to work it into the presentation. You can, if you might already know about this on the FDIC, you can look up the top 100 banks and thrifts by their assets, and it might be beneficial to help. We use this to explain to the client is, for example, Bank of America, you'd probably be surprised to learn that they have $22 billion in cash surrender value of life insurance. And and if you scroll down to the very bottom, I'll send you the link, you'll see that they also have $22 trillion in derivatives.
Wow.
And so what we're doing is no different than what the best financial institutions and investment minds are doing. We've just optimized it so that we can take advantage of the tax benefits, and we also have this great stress testing.
Right. Well, thank you. That's very helpful. And look, there's all kinds of little tidbits. So you guys, I'm not saying this is the only presentation that you do. I'm just saying that, this is kind of what works for me, but realistically, you probably know, Robert, as well as anybody on the phone, each client's a little bit different. So you're going to kind of tailor what it is you're saying based on the client. For instance, we know that most females are more concerned about protection than they are about retirement income, because that's our nature. We typically have kids, and we're typically worried about taking care of our kids and our husbands and our families and our households and this and this and this. And so we're more focused on protection. So when you're talking to somebody, you might, a female, you might focus on that as the best part of the plan. Everybody's a little different. Some executives are like, no, I don't, as long as I accumulate enough money, I can take care of anything. So just give me the ability to accumulate money, and I don't care about anything else. So everybody's a little bit different. And you just, these are just guides. They're just what has been working for me over the last 5 years. So thank you for the additional information.
Absolutely. Thanks, Grace.
Have a good weekend. So guys, that's what I love about doing these webinars, is because you always pick up little tidbits of information from a lot of other people. I'm not the only one out selling this plan. So, I'd love to hear from you guys. What's working for you? What are the hot buttons that you're hearing from your clients? And that would actually be a really great webinar that we could do one time, is, do a kind of a workshop for all the people that are selling it, and allow everybody to kind of come on and give their 30-second elevator pitch, or what's been working for them, or some of the objections that might be running into, so that we can come up with some strategies to help them overcome those objections. Or it may be something that one of you other guys have already run into, and you already know how to answer or respond to that, and that might be a useful webinar for everybody to share information. So Tag, Salman?
Yeah. Hey, thanks, Grace. Great presentation as always. Yeah, very well done. Quick question. So on the comparison slide where you're looking at the various investments, your deferred compensation, stocks, bonds, etc. Those dollar amounts that you describe on there, are those I should say the yearly income stream from them once you're able to draw out?
Right.
So on the bonus, deferred comp, and the self-funded IULs, I should say not self-funded IULs, deferred comp and bonus, is that after-tax dollars, or is that pre-tax dollars on those?
Okay, so if you look up here, and by the way, there's a spreadsheet that shows you what the numbers that we use, but we assumed pre-tax dollars here on the deferred comp, and we put in, the capital gains tax that they would take at distributions. We assumed a 50 basis points management fee. We assumed a 37% income tax bracket.
Okay.
So,
Okay, so then you've applied. So now the income tax rate was at 37%. Now that's the money that's when, while you're working, you're in that kind of an income tax rate. Well, I guess maybe I need to frame my question more appropriately. So when you start to draw the money out after, say, year 15, say you're 65, you're 66, whatever, you start to take money out of your deferred compensation plan or your 401k, etc. You will be paying, obviously, tax on those monies, probably at a lower rate than you were when you were working, because you were in a higher tax bracket while you were working.
Well, okay, so the way that you got to remember, this one was done for a specific client. This is a doctor that's earning $600,000 a year. So you gotta, some of these assumptions you have to rely on the client to tell you, right? And in this particular situation, this was a group company where each one of those doctors was earning $300,000 to $600,000. So they kind of gave us the assumptions that they wanted us to use, and we used those, right? So we used their assumptions. They just told us, and the point of that is that, not whether this is 25%, or the point of this is, even if you lower that income tax rate to whatever they tell you they expect it to be, then it's just going to adjust these numbers. But there's still, even if that made this deferred comp, let's say 1.6 million, it's still isn't going to come anywhere close to what we're getting. We've done it with all of them, believe me. Like we have some of the largest financial organizations in the country, executive benefit guys that are selling this to, your Toyotas and your, whoever, but all over these with their own numbers, their own assumptions, what their own clients want. And this was just, we kind of take what the clients are asking us to do to build these spreadsheets to kind of give them the assumptions. So you could put in whatever you want.
I see what you're saying. So for the bonus and the deferred comp, you've got $43,360 for the bonus. You've got $51,188 a year for the deferred comp. Both of those numbers are inclusive of a tax rate, an income tax rate, upon drawing it out of 37%. Right. Is that correct?
I'd have to go look at the spreadsheet that Paul made for this particular group, and it's actually in this PowerPoint presentation. It's actually, but I don't know if I can pull it up. Let me look. And we embedded it in this because this was, as I said, this is a real case and this was a real client. So, right. So we had to embed all the illustrations in here. So where are those? There they are. See if I can pull this up. So it just gives me those same assumptions that I put on there. And then it shows you here. So I'm assuming that that means that they used a 37.
Yeah, because obviously to net out 43,360, you have to take out, I could run the math real quick, but you've got to take out a much larger piece of money than that to net out the 43,360.
Yeah, for sure. But again, you go back to however you want to build it. We don't care. All we're trying to say is, no matter what you're doing when you're looking at these types of designs, the way I like to say it to a client is, look, and I just said it a minute ago, if I had the ability to take a 401k plan and if I took my 401k plan and I was invested in the market and I knew I was going to take distributions when I got out, no matter what tax rate or what those distributions were, and this was the amount of money that I was able to pull out. If I gave myself a zero floor on my stock portfolio, which, like, if you want to get a 6.88% rate of return, you're going to have to be in stocks, right? So I can't leverage inside my 401k or my stock portfolio or anything else with the same amount of risk as I can on this design without being in the market. I would have to be in a fixed rate of return. So if I want to leverage a brokerage account, I'd have to move all the assets into a fixed account. Therefore, I'm not getting 6.88% rate of return. So you can't have it both ways. Right. So when clients say to me, well, you're not really in a 37% tax bracket when you take it out, I go, look, think about logically what you're saying. If I put 3 times the money in here, it's going to kick all these other ones, right? But I can't put 3 times the money in here because I have the risk of losing that money. If I put 3 times the money in here, I now have to provide personal guarantees. That's a margin loan. That's what that is.
Right. Yeah, no, totally understand.
So if I want to do an apples to apples comparison, I'd have to move the money into a fixed account and then do the 3 times leverage. And now I'm only growing it at 3-4%. So I'm still going to kill it over here.
Yeah.
Does that make sense?
No, I guess my question was, it makes total sense. I just wanted to just clarify that, so it was kind of apples to apples that,
yeah.
So, you're paying taxes upon tapping into those retirement monies in the other 2 examples versus the insurance policy, life insurance.
Right. And look, every client asks you to change it up, do something different, and we just built some Excel spreadsheets to provide this. All we're trying to say is, look, we compared this to everything else that's on the street, and it's going to beat it. And by the way, sure, if I could figure out how to do this in a 401k and I could give you a zero floor and leverage it up 3 times, I'd be a trillionaire, because there is not a single person that wouldn't do this. Right? But
right. No, that's very true.
You can't buy a principal protection on an investment portfolio inexpensively as you can do it inside this policy when you minimize fees and expenses and charges, and you don't have somebody the size of an Allianz or a National Life of Vermont or a Minnesota Life that's providing those guarantees. So you can't duplicate this. It's almost impossible to duplicate this on your own. You know what I mean?
Yep. No, that's a powerful slide. I really like that. That kind of just gets down to the meat and potato, so to speak, of the that comparative. It really illustrates the power of the Kai-Zen product.
Yeah, for sure. This is my all-time favorite slide, because I can sit here and get into arguments with clients all the time. So when they go, well, if I put that money in here, then I'd have as much over there, and I go, yeah, but you can't, because you can't borrow it without the loan. So if you want to, I'll set up a margin loan facility for you to do this for your clients. But you have to provide the guarantees for that margin loan, and you have to fill out the credit checks, and you have to provide the loan docs, and you have to monitor it every year, and you're gonna have margin calls, right? So no matter what they say,
it ties everything together. And they say, well, gee, what if the market goes down? Well, like you said, it's across the board, because you're participating in the same in the same platforms investment-wise, S&P 500 or whatever it might be. So,
Yeah,
you know,
the great thing
that
about this
really
slide,
ties it all together.
yeah, the great thing about this slide is they sit there with their mouth open trying to figure out how to pick it apart. And I just let them sit there and try to pick it apart.
Yeah, that's why I like it, because it just kind of boils everything down to the brass tacks right there. And then you can have a conversation where they're throwing out the curveballs and hit each one of those curveballs out of the park. You know,
It's my favorite. It's my favorite slide of all of them because it's just so mind-boggling that you're going, how? I don't get it. How? And then when you say the leveraging piece, then they keep thinking, what's the risk? What's the catch? What's the risk?
right? Yeah, no, I agree. It's my favorite slide of your presentation as well.
Thanks.
It's the most impactful. Yeah, great job, Grace. Thank you so much. I appreciate it.
Thank you. Have a great weekend. Appreciate it. All right. I know that there was a couple more people that had questions. So Warren Davis, are you there?
Yes, ma'am.
How are you?
Good, good. I'm new to you guys as a group. I've probably been with you about a month. Hey, first thing, great presentation. I've never seen
Thank
nothing like
you.
this before. Secondly, how do I get that commission calculator?
Yeah, what I need to do, Warren, is I'm trying to look, I'm in kind of an unusual situation because this is, this is something, commissions is an issue that should be taken care of by your GA. So what I'm in the process of trying to do is work with the GAs to kind of get those to them so that they can show you based on your compensation level, because I have no way to know, what you guys are paid out at, who your GA is, et cetera, et cetera. So the real reason that I brought up the commission calculator, and we can have a conversation about it offline. You can tell me who your GA is, and we can kind of work with them. Or you can tell me what levels you're at, and we can plug in your levels, and then that would probably make it easier. But the real point of that was to try to show you guys that you're not making less money by doing the 70-30 split with NIW. Because everybody forgets about the extra money we're adding in there. And anytime I'm selling to a client, the first thing I'm asking them is how much they can contribute. They're telling you all they have. That's the dollar amount. That's all they're going to spend. So you could sit there until you're blue in the face and they're not going to come up with any more money. So, if you think about it, and I've sold them everything I could possibly sell them, and now I'm going to get to leverage that up and add more to it.
Right.
But even the spread comp makes you more money because you're getting paid. If it was $1, you get $1.20 just by spreading it out because the insurance company gives you a bonus for spreading that comp. So let's talk about that offline. I hadn't really thought that through when I brought that up. I just kind of wanted to stop wasting everybody's time. I don't want somebody to spend an hour on the phone with us if this really isn't for them and they really, don't want to do the spread comp and this really isn't their market or something they want to sell. I thought, let's just get that out of the way and, and then focus on the people that really do want to spend their time to learn it and make it a part of their business.
Right. I think I'm with you guys. I signed up with you guys. You guys sent me a bunch of forms. I filled out. I got it back to you guys. So
Okay.
I'm with you guys.
Why don't you just call us? Why don't you just call us after? Call us at NIW after. Where are you located?
I'm in California, Los Angeles.
Okay, so you need to ask for Janine Cooter. Her extension. Well, first off, the phone number is 972.
Hold on. 972
755
755
1582.
1582.
Now,
Okay.
Janine Cooter is the NIW in-house regional support for the West region, and her extension is 206.
Okay.
Now, the guy that created that calculator for me happens to be the West Coast outside regional, and what I mean by outside regional is his job is to fly around and go see, the agents, the agencies, and do all that stuff. And he's the one that created it. So what I may have to have is I may have to get you on a call with him because not everybody in our office has been trained on that calculator yet. So most people don't even know about it.
Okay. Okay, cool.
He and I were working on, it was something he and I were working on because I had to go do a presentation for a general agency. And I kind of said that to him. I go, I don't want to waste my time on a bunch of people that don't want, that this isn't their market. So if we just, did that up front. So he created it for me for that meeting when I was on the road last week. So nobody's seen it but you guys and that one other agency. It's all brand new.
It's great. Hey, real quick. I had a dinner. Went to dinner the other night with a county commissioner, and he was telling me that he was trying to find a way to fund their pensions. He was gonna have to he was raising taxes and all that type of stuff, or whatever. And
Yeah.
I'm trying to work with this guy. So
Don't
I don't know if
chase
you have-
that. Don't chase that right now, Warren. And I'll tell you why. The problem with the municipalities is they all have underfunded liabilities. The biggest problem is that they have been taking money out of those people's paychecks and putting into a pension. They cannot use those pension funds as collateral for these types of deals, and they don't have the money to put in the initial contributions. So we have some states, and I mean states, that are working on a solution to allow them to participate in this platform. The state that we're working on, and I can't disclose which state it is, but the state that we're working on is the farthest one along on how to set this up. And if they set that up, and if they can get it through the politicians and the voting and all the committees and whatever else, then we'll have kind of a platform. In the meantime, you're spinning your wheels because they can't use the pension assets as collateral, and they can't afford, they're out of money, so they can't afford to pay the initial contributions in. So we had to come up with a creative solution. But in order for that creative solution to be a viable one, you have to get everybody to vote on it, and you have to have a cookie cutter to take out to other people.
Right. Yeah, he was just running a bunch of stuff by me. He told me they just bought up the Aetna's book of business. I guess Aetna's leaving the state, so they had to initially buy the book of business from Aetna. And we were just bouncing ideas off of one another. And I was like, well, I might have something for you, but since you just told me this.
Yeah, believe me, every single state, county, and anybody else that has a pension obligation has been coming to us. But it's a different sale because they have a different problem. They don't have any money at all. Like, they don't even have enough for the initial contributions. The difference between them and the corporations that we're talking about is the corporations are already spending this money on deferred comp or bonuses. So it's dollars they've already allocated. So it's a much easier sale. And those dollars that they've already allocated aren't typically tied up in some kind of pension or qualified account, because we can't use qualified accounts as collateral.
Okay, got it.
Make sense? Have a great weekend, Warren.
Thank you.
Said, is it war win?
War win.
Okay, I kept saying war in, but war win. All right, have a fantastic weekend.
Take care.
All right, let me go through one more time, guys. If you have any questions, this is your last chance. And then also, if you wrote out your question, I'm going to have to read those and respond back to you after I get off this call, because it's really, really difficult to read and try to scroll at the same time. Rick Sandlin, you have a question?
Hi, Grace. Yeah, thank you very much for all this great information.
Oh, you're welcome.
I'm breaking into the market. I can't understand why anybody wouldn't want to get into this market to show it. But I'm running across people that are saying, well, I'm happy with my investments. How do I counter that without being argumentative?
Well, I typically say, are your investments going to provide for you enough money for you to live from 65 to 85 and provide the $260,000 you need to set aside for just long-term care expenses?
Okay.
And if they tell you yes, they're lying, and I'll tell you why. If you go look up the statistics from Social Security, they will tell you that the average person retiring today, 83% of those people haven't even saved $250,000.
Wow.
That means that you're either picking all 17% of the people that have saved $250,000, and I don't think $250,000 is going to last for 20 years. Think about that. $250,000 divided by 25 years is $10,000 a year. Who lives on that?
Right, right.
What kind of rate of return would you need to have not to spend that principal? So if you'd saved up 250,000 and you were getting a 10% rate of return, that means $25,000 a year for you to spend.
Wow. Who is the marketing agent for this? I'm in Florida. Is that David Green?
Who's the marketing agent in Florida is Dave Green. He's the regional, and Helen Bolden is the internal.
Okay, how much? What is his phone number? May I have that, please?
It's the same thing, 972-755-1582, and his extension is 301.
Okay. I've got a bunch of ideas I'd like to run by him, but I know I'm trying to be respectful of your time on this Friday before Labor Day.
Yeah, no problem.
Thank you, Grace.
All right. Have a great weekend, Rick. Okay. Tag? Is it tag or is it tag? Tag.
It's tag with a long A, just like vague, except with a T instead of a V. Vague tag.
Why didn't you spell this correctly? No, I'm kidding.
So just, sorry, I had another question, but real quick. So I know the Sarbanes-Oxley rule. There was mentioned on a previous webinar, I think it was last week, about nonprofits and the ability to apply. It was a tax. It's some new tax changes that have happened, and I know certain states exclude the Sarbanes-Oxley for nonprofits, and some include them. Is there a site or any kind of information we can access to determine which states exclude or include Sarbanes-Oxley for nonprofits?
You know, that's a good question. I haven't been following that. And the reason I don't follow that is because I never bring up the topic until the clients have decided that they're doing this and implement it, because I don't really care how they offer it or how they pay for it until they've made the decision they're going to do that. So I don't get into whether it's Kai-Zen or whether it's Try-Zen or whether it's corporate split dollar. I basically make them make the buying decision. And because I want buy-in first and foremost, and then I say, now, how are we going to pay for it? And the reason I do it that way is because every company is a little bit different. And I don't know who their attorneys and their CPAs are. And I don't know what their rules and regulations and pitfalls and what their concerns are until we get into that. Now, if it's a large enough company, that's when we bring in our outside CPAs and attorneys. That's why Try-Zen is a bigger split than Kai-Zen is, because I don't have the expertise to go talk to a PricewaterhouseCoopers and argue with them about the rules and regulations of corporate split dollar and Sarbanes-Oxley and all the other things, right? And I know any advice that I give them, I'm going to get sued over it. So this is where I want to go bring in the specialist, and I want to get that liability off myself, and I want to let that guy, Arlen or Alan are their names. Those are the CPAs and the attorneys. And I want those guys to be the ones talking to Pricewaterhouse. And, you know, if the whatever hits the fan, that's the phone call they're going to make back. So that's the reason why the split's different on Try-Zen. I personally, but your commission's higher on Try-Zen. So you still, again, make more money even with the higher split, because instead of putting in 32, as in my example, and then I got to put in 58, I'm also leveraging up 60. So like, let me show you what I mean.
Yeah, because of the tax savings, essentially, of doing the Try-Zen.
Right.
Yeah,
so even if I'm doing that higher split with Try-Zen, I'm still splitting a much higher case. Where's mine? Mine's on here somewhere.
More cash is being put into because of the tax advantages.
So you can see here, I was paying 70-30 split. I was putting in 32 of my own. I got to leverage up 33.7, and now I get to put in 50 and leverage up, or 58 and leverage up 60.
Yeah, it almost doubles.
Yeah, exactly. So it's a much bigger number. So again, we could get into all kinds of spreadsheets and ledgers and whatever else. You're going to make a lot more money no matter what. And the good thing about bringing in these outside consultants is that you remove the liability from yourself. You're not an expert. You don't want to be an expert. You don't want to have to worry about looking that stuff up. Let them do it all. And, I always say to a client, look, that we have the people, right? And 9 times out of 10, your clients don't want to talk about that. They want to know that you have somebody that knows those rules and regulations. And you just say, tell me the person that your attorney, who, that's going to be dealing with your Sarbanes-Oxley, your executive benefits, your corporate split dollar agreements, blah, blah, blah. High level is what you're going to be handling. Details is what you're going to turn over to the specialist.
Okay, that makes sense. One last quick question, and this may be a stupid question, but I'm going to ask it anyway. So you mentioned about the general agency. I'm an independent licensed life insurance agent. I don't have a general agency. Do I have to have a general agency?
You
signed
do.
up through a general agency?
Yeah, everybody's got a general agency. You might not know who they are, but everybody that's signed up with the carrier has a general agency. So you're going through somebody. And the reason that you're doing that is because insurance companies typically are paying those general agents to provide support and service for them. So in other words, insurance companies don't want to staff the people that are helping with the underwriting requirements, the paperwork, the licensing issues, the E&O coverage, all that kind of stuff. And so what happens is insurance companies provide to these general agencies they pay them part of their profits to act in that facility for them. So every independent agent has a general agent.
Okay, so if I'm understanding correctly, because I've got one locally that I've been in communication with, I haven't signed up formally with them yet, and they're good, and they've got some good support, et cetera, et cetera. So if I were to sign up, and I could purchase EOB insurance through their platform and all that kind of stuff. So I guess it sounds like I would do that then. And going forward, if I have a deal that I'm presenting, I'm just trying to follow how all that works, like with you guys and then with myself and them. I don't believe that they even take a commission per se, or it's very small, if they're doing a very limited amount of work, like on my behalf. Now, if I brought them in to kind of help do some stuff, then that's different, right? How does that typically work?
So the GAs will talk to you and assess your commission level. So in other words, they're going to contract you at a specific level based on the service that they need to provide for you.
Right.
So they're going to come back and individually talk to you about what that level is. They sign you up directly, so you get paid by the insurance company directly, but they're managing your book of business. What that means is they're doing your licensing, they're making sure that you're approved in all the different states, they're making sure your E&O is up to date, they're processing your paperwork and following it through, helping you with underwriting as you're writing that business. That has nothing to do with us. We go on the app as an app split for providing you all the stuff you've seen today. The statements, the illustrations, the bank funding, all of that stuff. And it's just an app split. So we go on the app for 30% of Kai-Zen and 50% of Tri-Zen. And then you take the remainder. That remainder gets paid out at whatever level you're on, depending on where your general agent set you up.
And then yours is that your payout through the insurance company would be just directly through the insurance company. Is that
correct.
How that works?
That's correct. They pay us directly. They pay you directly.
I see. But it funnels, for me, it funnels through my GA then, essentially.
Correct.
Or do they just, based on whatever agreement we have, I see. But my,
when I did that grid today, I did that based on, a typical high producing agent already, I've already taken into account what what you're going to get paid.
I see. Okay. Do you know what typically the GAs get paid in these types of deals? I mean, you have any
well, let me
thoughts
take
on
it
that?
offline with you, Tag, because You know, every single GA is going to be different, whether you're a broker dealer. It all is dependent on the liability that they have. It all depends on production that you write, what they have to provide for you. They're all a little different. So you have to kind of give me an idea of who it is that you're working with, and I can give you an idea. But because we have so many broker dealers and we have so many different organizations that pay at different levels, you know, it's not a good platform for me to be discussing that. That's something you probably should be discussing with your own GA.
Yeah, no. I did. Yeah, that I understand. I'm just kind of new to this, so I just wanted to make sure that I didn't.
Yeah, no. I get that. And I would be more than happy to, you know, discuss what I think based on who the agents. I know what all these general agencies are paying, so you know, I'd be more than happy to discuss that with you. I just don't want to be in a situation where somebody hears the number and then they go, well, my broker dealer doesn't pay like that. Well, your broker dealer is different because your broker dealer has a lot more liability than a typical general agency. So it's all over the place. And I just don't want to offend anybody, any of our general agents.
Sure, totally understand. Well, maybe we can take that, like you said, we'll take it offline at some point.
Yeah, just give me a call in the office.
Great. So if I were writing some business then and things were moving forward, I would want to apply, like say for example, to Minnesota Life, right? So I would apply through my GA to get oh gosh, what do they call it? Endorsement through not endorsement. There's a name that they give it when you're accepted by the insurance company to sell their products, right? So
yeah, if you haven't signed up with them, they typically collect all the paperwork up front, and then they don't actually appoint you. That's the word you were looking for. They don't actually appoint you with the carrier until you turn in your first case. So
that is correct.
Yeah,
how it works. Okay.
Yeah. But they've done all the paperwork. They've approved you to sell it for them. They're just not going to start paying the fees because each insurance company has to pay a fee to appoint you. So they don't want that fee to start until the day that you turn in your first piece. But you need to make sure that you've already processed all the paperwork so that you're able to actually sell for that company.
I see. So that makes perfect sense. So I can still pitch, for example, the Kai-Zen product to a group or an individual without being appointed yet to any specific insurance. Is that correct? That's correct.
Once you've filled out all their paperwork, you have the right, you're ready to go. They just don't want to pay they don't want to start paying and start the time clock because those payments are annual. So they want to make sure that you're ready to go before they actually send the state the fee.
Yeah, and that makes perfect sense. All right, well, thank you so much. I appreciate that. And at some point, maybe next week or something, we can touch base live if need be.
Better do it before next week. Today's the only day you can do it. I'll be out of the office until the 15th, and I'm going to be overseas.
Oh, will you really? Okay, well, maybe I'll reach out to you here. You're what, 1:22 your time, right?
Right.
Yeah, I'm calling out of Arizona, so it's 11:22 my time. Okay, I will. Maybe I can send you an email. Is that the best way to do? Just send you an email, maybe schedule. We can spend just a little bit of time on the phone.
Perfect. And if you can't get a hold of me, talk to Janine, and she can hook you up with the West Coast Regional. The reason I'm not saying his name is because I don't know if it's been officially announced yet. We have a new West Coast Regional, so I don't know if it's been officially announced. So I'm leaving his name off, but Janine will be able to tell you because it will be official by next week. So, so she can hook you up with the new West Coast Regional.
Okay, great. Does Janine have like a extension number or anything? Or?
Yeah, Janine's extension is, I can look it up. Hold on, 206.
206. Okay. All right. Awesome. Okay. Thank you so much. I appreciate it.
You're welcome. Have a great.
Have a great holiday weekend.
Thank you. Okay, I just saw Nick Thornhill.
Yep. Hey, Grace, how are you?
Good, how are you?
Fantastic, thank you. Yeah, like everyone said, it was a great presentation. I've been out of the industry for a while, just kind of returned. I did actually sell a Kai-Zen plan to a physician friend of mine years ago. So I'm back in it. My sister is high up as far as human resources in a $1 billion corporation. I've got some other friends from Harvard Business School that were, super well connected with a bunch of Fortune 500 companies. So, selling to getting in the door with a friend of yours that's a doctor and getting in the door with, a Fortune 500 company, even if this, to have a contact with the CEO, what does that look like? Or it might be a side conversation, and then just protecting yourself on deals if you open it up. I had a couple questions like that. I don't mind opening doors. It's just, how do I protect myself on huge deals, or when do you recognize Tri-Zen versus Kai-Zen, in a quick, Cliff Notes version, stuff like that.
From my standpoint, you can only sell Tri-Zen if they're a C corporation or a not-for-profit, because
Okay.
it doesn't make sense.
So a 501c3 or a C corp. Okay.
Yeah, because the C corp tax bracket makes economic sense as to why they would want to do it this way. Because
Okay.
in an S corp or a partnership, it's 100% tax pass through to whatever your tax rate is. So it doesn't make sense to borrow money from your corporation if you're at the same tax rate, right? The whole purpose of doing that is so that you don't have to pay taxes on it, and ultimately you have to pay the money back, right? But
Yeah.
you want to pay it back at the long-term AFR rate, and so it doesn't. I mean, you can still do it in any such. You can borrow money from anybody you want. It just
Gotcha.
doesn't make a lot of economic sense unless you're a C corp or a not-for-profit.
Okay. So
That's the first thing.
I'll dig into that one later. So
Yeah.
a couple of things is, so I'm in California, but I've got some, people obviously on the East Coast and in Seattle, different things with companies. How do I have to deal with different regional people, or just because I'm in the West Coast, just bounce things off Janine Coote, whatever, I think.
Yeah.
Janine Coote or,
Janine is your contact person. So no matter
Okay.
where you sell, that you're going to be still working with the West Coast people.
okay.
Now, you have to think about the way that we as a firm work. If I'm on a large case and I know that Dane, for instance, has more technical expertise than I do, I'm going to bring him in,
Totally.
right? And
Yeah.
and we will do the same thing for the agents. If you aren't, for whatever reason, gelling with your team, we don't care. We'll put you with whoever you gel with. If that's Dave Green, if that's Buck, if that's Dane, if that's somebody else, it's not a big deal. And the reason we have the regionals is to provide the additional support. And I think you'll like all of them. But even our regionals will get help from each other. So I can't tell you the number of times I've seen Buck and Dave out on the same appointment, or Dane and Dave, or myself and Dane. So we're all about helping each other get the client, and we know who has the most expertise in the specific areas, and we're going to go get them to help us. And we do the same thing for our agents. If I am talking to you and you give me some circumstances where I think it's more appropriate for Dave to be working with you,
Okay.
I'll pass you off to Dave and say, hey, you really need to call him. He has done this part of the presentation so many times, he's got this nailed.
Okay. And that's something, is a 50-50 split or just a negotiated split, or what does that look like?
No. Okay, so the reason that the splits are the way they are is because insurance companies have set up the commission levels for 10 years. We're not out of the loan for 15 years. So if you think about the reason our 30% has to be the 30% on Kai-Zen is because we're servicing those. You see this here? Each one of our clients, we have to pull up these numbers for every single year with the current cash values and run new stress test. So it's very, very labor intensive because
I'm fine splitting. I know, like when I sold the doctor, whatever, I just did it on my own, and that's fine. But when I'm in a group, I'm happy to give you guys the money. I didn't know if there's an additional split on top of that 30% or
well,
anything.
what we typically do is, look, if we feel like we're going to have to bring in some other people, and let me give you an example of what I'm talking about.
Okay.
There was a large hospital who had a great relationship with the agent, and he, you know, that hospital had been buying, that guy had been buying his own individual stuff from this particular agent, got a great relationship, brought him in, et cetera, et cetera. But when it came down to talking about executive benefits for the hospital, he said, we have specific consulting companies we have to go to. Why is that? If I'm human resources for, you know, a 6,000 man hospital group, I'm not making the business decisions on my own. And as a matter of fact, from a liability standpoint, for the way that the board looks at it, I'm not going to even let my board make that decision. If I decide as a board that I like this platform, some groups are so big, they are going to send it out to a consulting company. Now, there's hundreds and hundreds of consulting companies out there.
So then we would go to their consulting company, whatever, and meet with them. Okay,
now, we have 3 of the largest of those consulting companies that have already signed up. And so what we would typically do is we typically say, okay, if you're going to send it out to a consulting company, and that consulting company hasn't already approved our program, Mr. Hospital, you probably would want to save yourself some money, because it's going to cost you money to pay them to get up to speed to do the due diligence. You could always go to one of these other 3. Well, those other 3 are name brands that everybody knows.
Like which ones? Which ones?
Well, I can tell you 2 of them. I can't tell you the third because it's under non-disclosure. But one of them is Aon, one of them is Mercer, right? So we have agreements with them already. They've already vetted the programs and they can already sell it. So it would make sense from my perspective if we collectively, you and I, convince the hospital that they want to use Aon. Now you're going to be in a situation where you're going to have to split your commission with Aon. But from my perspective, if they send it to whoever they were going to send it to, that firm is going to do everything under their power to kill the deal for you.
So, okay, so that's why you want to get them to Aon or Mercer if possible?
Of course. And they're going to try to kill the deal for you because they don't want to lose the business and they don't want to let somebody else in the door, because they are typically the ones, even though they say that they're the consulting company and they don't have a vested interest, they charge fees to give that advice. But then as soon as they give that advice, they go, we don't think this is a really good plan, and there's a lot of risk associated with it. And by the way, we can send in XYZ guys, which are, you know, code for their team, to discuss and come up with the best plan for you.
So they're really backdooring the business on.
Yeah, of course.
Of course. Okay, gotcha. Okay. So they're not okay. They're not objective in the whole thing.
Exactly. That's exactly right.
And
it's
so
it's no different than when a individual client says to you, I want to take this out to my advisor. Well, what is the advisor going to tell them? It's not a good plan because it's not my plan.
Okay. So if they use this third party person and we bring it, they're not going to go say, hey, we can offer that, are they? You know, this other third company who's not on non-disclosure.
No, they'd have to come to us, vet it, and then that's why I'm saying,
okay,
if they haven't already signed up with us, they're not going to want this company to sell it with us. They're going to want to try to send in their own team of guys. And I can promise you that happens, because it's happened to me with every large case. They've sent it out to, you know, Buck Consulting, which actually Buck, in fairness to Buck, they did come back and say it was a great program. But, and, you know, but they've sent it out to, you know, PricewaterhouseCoopers. They've sent it out to their law firms. They've sent it out to, you know, they've sent it out to Mercer. They've sent it out to Aon, which is some of the reasons why we went to those companies. So we know they're doing it because they don't want the liability of making a bad decision. So they want to offload that liability and say, hey, we went out to the consulting company and the consulting company is the one that told us it was a good plan.
Gotcha. Okay. And then what's saturation look like? I mean, obviously you've got a great plan. I mean, you know, if I go start knocking on some Fortune 500 company doors, like what does that look like? How do I know who's doing it?
Surface.
I'm sorry?
We haven't even scratched the surface. And the reason we haven't is because
Like
We've been
1%?
doing this for 5 years, but when we originally started the plan, we went out to our own distribution. Our distribution is the wrong distribution. These are agents who are selling to high net worth clients.
Yeah,
So
that's kind of where I was, but okay.
yeah. So
But the good news is high net
here.
worth clients know other high net worth clients that own businesses with executives. So
Yeah, and what's happening to me now is, well, what started happening and the reason we moved into the group space was because a lot of those clients started saying, hey, can you come talk to my employer? I want my employer to provide this benefit for me.
gotcha.
So all my clients were getting me in front of these groups, right? And then I had to kind of figure out what are the hurdles of the groups. Well, wow, I got into these. I could get into big hospitals like that. Closing them was a different story. And that's when I started finding out, wow, they send these out to consultants and those guys try to kill you. It's like they come back and say all kinds of garbage. It's amazing. I've learned a lot in this process. But it kind of forced us to go, okay, who do we need to go to? What do we need to do to get around these issues? And so I could tell you that we are, we've been in this group, we've been doing this, but we've been selling it to individuals and small businesses for 5 years. We needed to first, work out all the bugs, make sure all the lending was correct, blah, blah, blah. So it was really a test market for us for about the first 2 years. Then we kind of made a shift and we started trying to call on groups. And it took us another 2 years to really work through that group space because, as somebody said earlier on this call, oh my God, who wouldn't want to do this? And that's exactly what we were finding every time we would go into these companies. So we couldn't figure out, why aren't we closing companies left and right? Well, it was because we had these people behind the scenes going, oh, no, no, no. Like we even had one company tell the clients that it was illegal to do corporate split dollar. We're like, we're not the corporate split dollar people. Corporate split dollar is already written up by the government on the guidelines. You just follow those. All we're doing is adding more money. So, you have to go out and actually call on these people to figure out what all the pitfalls are so that you can come up with all the answers and put your team in place. And we've got a team now. And now we are closing large corporations very effectively left and right. So
all right,
I can tell you,
if I've got a big one that my sister is a pretty high up in, she's one of the heads over HR, which is also a good play, I would imagine, because they're dealing with
this plan.
Not yet. So I'm just kind of back into this, and this is the first webinar I've been on in 5 years. So I've got a lot of friends in Southern California who are extremely wealthy or have a lot of ties to bigger companies. So I'm just trying to get re-educated so I go in with the right person if I bring it into this kind of a deal. Because, when you're dealing with family, it's one thing, there's a level of, hey, I'll listen to you. But if I bring in a third party and pitch them as the expert to talk to my sister, that's going to be very different,
Well, my suggestion to you is I would go to your sister and I would say, I'm not going to give you any information. I'm not going to give you my opinion, and I'm not going to give you my sales pitch because you are my sister. But I would like for you to go listen to this webinar or set up a conference call and let her talk to us one-on-one.
Who would I do that with? Well, that would be Janine, because she's out of North Carolina in the company.
Well, you're out of California, right?
Yeah.
Yeah. So that would probably be us. But you can do if you're going to do a webinar, sort through with Janine, just set that webinar up and let me do the first one to her. And the reason I'm saying that is because what I did when I first went out is I would go to my CPAs and my attorneys that we've been working with, that we had a relationship, and I'd say, I would like you to do me a favor. Take a look at this program and tell me what you think. Try to pick it apart. And the reason I did that is because now you're asking them to protect you. So they're going to go in and they're going to try to pick it apart. Well, we've had everybody already try to pick it apart.
Gotcha.
Right?
Yeah.
Once she tries to pick it apart to help you, Then she's going to go, God, this is really actually good.
Gotcha. And so try to get you on the call for her with that one?
Me or Dane?
I'm sorry?
Me or Dane? Dane's our CEO.
Well, whoever you suggest. So, 'cause I
Yeah,
trust you.
I just start there, and
Okay.
then let her kind of go through it with you, so that she feels like she's, as a sister, protecting you. And I'm not saying that
Well,
so that you
then it
tell her.
takes off.
I'm
Then it
saying that
takes
so that
off
her
any
motivation.
interest.
Well, I'm saying it so that her motivation is around learning it to try to understand it, to try to make sure that you're not selling something that could get you into trouble, I guess is the mindset that you want her to be in.
Well, yeah, totally. And I don't want there to be like, with corporations, oh, your brother showed you this. Here's the vested interest. But I say, hey, you should look at this company and check this out. Then it would be very different if I've got you on the phone and you as an expert with all the big companies you're working with, top 10 banks, et cetera, using this platform. She'd be like, wow, that's awesome. And it would take them going, oh, your brother introduced us to you. You know how it is with corporations. Yeah, got it. So that's part of the thing, is protecting her and actually not losing the deal because of, a family type situation. So, all right. What's the best way to contact you, Grace? Is that just email?
Contact Janine, because I'm leaving town.
Okay.
So contact Janine at that 972-755-1582 number, and her extension.
206. Gotcha.
Oh, thank you. Yep.
Got it. Yeah, I've been taking notes. And then too, as far as if I bring in a big deal and just work on it, I just tell you all about it or put it on like a contact list or something. And just to, is there like any way to say, hey, we already have someone working on that deal, or I don't know how much competitive.
We only have the ability to help protect them once you've run an illustration. So
Okay.
you would have had to have collected a census and data. And the reason is because, like you, I don't know who's on the phone and I don't know what companies they're calling on. So,
Gotcha.
there's over 100 people, there's over 130 people on this webinar. I have no idea who they're calling on.
Okay, gotcha. Okay.
But once we do a census, then we know who they are, and we can say, we're already doing illustrations for them.
Fantastic. Okay, that's all I need to know. But and that's fair game. All I need to know is the rules, and I can play by the rules. So
fantastic. Well, welcome back. Hope it works out for you.
yeah, thank you so much.
All right. Have a
Appreciate
great
your
week.
time. Have a great one. All right, enjoy.
I cut you off, Nick, but thank you. I think you said I enjoyed it, so I appreciate that, and I didn't mean to cut you off. Okay. So I don't see anybody else's hands raised. Last chance, because it's already like 1:30, something like that. So we've gone way long, but thank you guys very much. Have a fantastic weekend. Anybody that needs to call us, call us directly after the conference call. My extension is, I have to look it up, 102. So if you guys need to get a hold of me, just that 972 number is fine, and extension 102. Have a fantastic weekend. Thanks for participating.